GETCRACK. Wake up, motherfucker.
Called his life about to get at the Federal Reserve?
Well, it's never an easy path when you get to a time like this. But remember, Jonathan, this institution was by design anticipating that there would be political influences on it. And so a lot of safeguards were put around it to allow the individuals that sit around that table to really maintain their focus on the American public and the mandate that was given to it by Congress.
There is a confusion, though, Esther, given the fact that a lot of the potential proposals would have a fundamental effect on the trajectory of the economy, and that's certainly what the market seemed to be responding to. Do you think, if you were on the Fed, you'd be rethinking just how much further the Fed can cut?
Well, there's no question, Lisa, that you have to take into account fiscal policies and the impact they can have on the economy. And of course, when you're making a forecast, you have to be thinking about what are the risks around that forecast. Whatever baseline you set, you have to be thinking about what lies ahead in terms of setting a path. And I thought yesterday, the chairman was pretty clear that he wasn't going to offer any forward guidance about what comes next. And I think that's really the right way to handle it at this stage.
At this stage, December isn't going to be so easy because they do have to release a new statement of economic projections. I'm sure that you are very glad that you don't have to offer up yours. How do they signal a potential scenario analysis around something that the market is actively considering and responding to?
So I think where we will see that, certainly you could see it play out in the median assessment of those 19 forecasts, but you'll also see it in the statement where this committee will talk about the balance of risk, and they will talk about their own assessment of what the path ahead might look like. Today, they're relying on what they know, which is we have the economy that's handed to us. We are saying risks are roughly in balance. You heard the chairman say several times what the trade-offs are between going too fast versus too slow. And so it will be a while before they get any clarity on what steps will be taken in Congress, in the administration, that will begin to bend the curve of those forecasts.
China announced $1.4 trillion in stimulus over 5 years. Eunice Yoon joins us now. We said we were going to go to China and actually see the stimulus package. Do you have it right there with you, Eunice?
Yeah, that's right. That's right, Joe. There could be more announcements in the next hour or so, but so far, China's long-awaited stimulus is not what investors had been hoping for. You mentioned the headline number. It's big, $1.4 trillion, but that money is not being used to stimulate demand. 60% of it is going to local governments to issue new bonds over 3 years, including this year, to pay off what the government calls hidden debt. So this is off-balance sheet debt, debt that hasn't been recognized, which has been a primary source of risk in this economy. In addition, local governments will be allowed to issue more special bonds over 5 years to raise more funds for, again, the same purpose. The finance minister signaled that China would be open to the idea of expanding its fiscal deficit next year, so implying that there could be greater stimulus then. But so far, the stimulus that we're hearing is going to mainly come from refinancing that debt at the local level. And so the finance minister said this would free up about $85 billion over 5 years so the local governments can spend more. But there is nothing in the plan that puts money in the hands directly of consumers or companies, therefore stimulating demand. And that's one of the reasons why you saw the stocks selling off so much. All these, the Chinese ETF in pre-market, as well as Alibaba and others.
A lot of stimulus. We stimulating ourselves a little yesterday with Jay Powell and another quarter point or this week. Eunice, I don't know what that does. It's a time that I think is fraught with uncertainty. We always say that more than usual. Can you update us on what kind of relationship we're going to see between the president-elect and President Xi. That's a weird one to Trump has said very, like, sort of complimentary things about Xi, how smart he is and how he exerts, you know, kind of scary when he says that he admires the way someone exerts that much control over so many people. But you got the Taiwan issue, and you know, we want to, you know, onshore a lot of stuff. It's just you must be. Can you sleep at night? There's a lot for you to be thinking about.
Well, there's definitely a lot of uncertainty, and there have been several research houses that expected that this stimulus plan could even be bigger than what the policymakers originally wanted. Nomura had said that it could be 10 to 20% larger than expectations. We don't know whether or not that's going to come to fore because we are still waiting to see if anything else is announced. But in terms of the relationship between Xi Jinping and President-elect Trump, as you said, the one thing you had mentioned, tariffs. So President-elect Trump had said that he would hit China with 60% tariffs. That would be very disruptive to the economy, something that China would not want to see, especially at this time when they have a jobs problem and excess capacity in several different industries. At the same time, President-elect Trump has signaled to Xi Jinping that he could potentially do a few things that the Chinese would welcome, such as a softer approach with Russia's Putin, for example, which is a chief ally of China, maybe a weaker position on Taiwan, which also Beijing would appreciate. And then President-elect Trump has expressed contempt for the allies. So in that way, China could potentially benefit from a lack of coordination and this coordinated front that they are seeing for their trade practices, especially on, say, EVs, for example.
So we're going to talk about what's happening overnight in China because the country there announcing $1.4 trillion in stimulus over 5 years. Joining us right now on how that stimulus will impact investments in China. Meanwhile, by the way, we should say the Hang Seng and a number of the index is down. Want to bring in China Beige Book COO Shahzad Qazi. I want to get that right. So what does this really mean? I would have thought that that kind of number, you'd have things flying in a sort of David Tepper style way, but not the case.
No, not at all. Look, this is not the stimulus that markets were looking for at all. This is not stimulus, I think, to begin with. What they're doing is recycling debt. And we've seen this playbook in China over and over again. I don't think this does anything to actually stimulate growth, not at least in a way that's going to be meaningful for markets.
So when you say they're recycling debt, what do you mean? Well,
what they're doing is the town and local governments, you can now go out there and issue more bonds and take all this hidden debt, bring it onto the balance sheet, and then some more. Some of the debt that's owed by the local governments will get transferred onto the central government's balance sheet. So they're just moving the money around. That's great, brings out, your interest rate payments and so forth, perhaps, and gives you some more money to maybe pay workers who haven't been paid, but doesn't do much.
What is your gamble on the next 12 months in China?
Yeah.
Mr. Tepper, I just referenced him, was sitting here, and that week he called it right. Things have gotten more complicated since then.
Oh, yeah. Look, I think a lot of those calls were actually probably not as right as they sounded at the moment. You haven't gotten a bazooka-style stimulus out of China. You don't have anything that's happening that is going to really stimulate growth. You don't have a muscular housing rescue package. You don't have a household-focused stimulus program at all. And I don't think it's happening no matter what happens in the next 12 months. The prospects of a trade war as of Tuesday just skyrocketed, obviously. What I think is happening here is that you got Beijing reserving some of that fiscal power and saying once the trade, if this kicks off and really starts hitting us, then we move in.
So, let's talk about the trade war, the impending trade war. In your mind, what does that look like? How does that play itself out? Walk us through the sort of the decision tree here of what could happen.
Well, look, I think the Trump folks are more or less already working on what the plans could look like for the president on day one, right? And how big they want to go. And those debates are starting now. It's all very, very live. Now, we're going to find out once, of course, Trump takes office, what the actual priorities are and how soon he starts making those announcements. But the announcements, of course, could be very staggering, could be very dramatic and very bold, which will have a very real market reaction. We'll see what the actual economy, impact on the economy is. And I think that's where China is stepping in. And they're saying, we will provide the money to our manufacturers, to our factories, as they've already been doing, by the way, to help cushion the blow.
Right.
And so they're going to keep that stabilization effort going.
How should investors, I mean, one of the most owned companies in America and one of the most successful companies in America is called Apple. And they have a huge manufacturing reliance on China. What do you think the impact, how would you even think about that right now?
So there's been a target on the back of American companies for a while, and I think when we talk about China's retaliation, outside of doing things like putting their own tariffs, which I don't think mean much in the larger scheme of things, they could go after American companies. And you know, so who do they go after? Do they go after Apple, or do they say, forget about this? There's a whole bunch of medical equipment and pharmaceutical production happening in China that the Americans rely on. We're going to start disrupting those supply chains. So they could really pick, how hard they want to hit us. Their toolkit is limited overall. We've got a lot, bigger arsenal, but they could still cause a lot of pain.
What's up, people? Howdy. It's been a good day. It's been a good day. Well, I mean, it might be an awesome day if I gambled on AAOI, like I told yesterday, like the riskiest of the stocks. But hey, if you did Axon, my second favorite stock in the stock market, you did good. You did good. So this week, you did Axon, you did Palantir. You had a great week. Great week. Now, I guess I missed some winners. I missed AAOI, and I guess I missed Geo. I didn't know prisons were gonna fly real high on the elections, but prisons are now bullish. Okay, guys, so let's look at the charts. Now, even if you don't trade certain charts, you should always study charts. The more you study, the more you get really good at picking the winners, So this is Axon, all right? This is a favorite company for most people. Well, let me bring it to the big screen. Okay, you guys see it. All right, good. Now, you seen the logo on. Man, I should find the logo and put it on here. Once you see the logo, you should burn it in your memory. This is how you get winners, man. Companies with very good logos always do well, I think. Man, is there a good look? Where's the yellow logo? Come on. But yeah, body cameras, and they're getting to drones. All right, let me see. Axon. let me get a good logo. Yeah. How about that? There you are. Here, let me copy and paste it. Burn in your memory. There you go. You see that? There you go. You see that everywhere, don't you? Everywhere you watch those body cam videos. Shit. And you guys thought it was too pricey. No, it's too expensive. Nah, it's not expensive enough. Apparently, it's $600 now. Oh shit. Up nearly 30%. So if you expect me to read 10Ks, 4Qs, whatever, you know what? I can't do that. I just look at charts, man. I'm just looking at this. Now, this is a beautiful chart because you look at this. The earnings in February 24th. You got this green candle here. You start building a top range. You fall back down to the bottom of this channel. You go back again, July. You go back down into the next earnings. Next earnings pops right above this whole channel area, right? This range. That's a really good indicator right there. And then once you move in, right? Let me zoom in. Once you do this, right after the earnings, and then you fall back, you don't drop below 50% of this whole move. So 2 days after earnings, you got one green candle, next green candle, which is basically overlapping this wick right here. When you don't drop below 50%, you're not retracing all the way through it. That represents hidden demand right in there. And then after a while, it climbs back up. You got this green candle. I don't know if there was news or whatever on that point, but after that, you start moving in this range, right? So you could draw it. Like the moving averages start going in parallel upwards. You have an upward slope now, right? All the way to the next earnings. So that gives you an indication that, well, more likely than not, earnings will be good because buyers keep going in there. Now, would I sell? Yeah, probably. I think we're done for most of this month. For the, I think we're gonna go sideways to down from here. People are gonna start thinking about taxes. The New Year's is just around the corner. It will happen pretty quickly. People will decide which ones to cut, and then they'll pair it with losers, right? So there's a lot of losers on the other end. Who are the losers of this year? Well, after elections, it's all the solar stocks. So TAN, the solar ETF. Let's look at some losers here. What's the big one? Nova, that recently, look at that. Down 15%, was down, I think, yeah, 50%. Yeah, then down another 15 here. Yeah, so they're going to start cutting losers. Expect this stock to drop all the way into New Year's. Guess what? Might be something to trade into next year because they'll oversell it and then it'll bounce back. Doesn't mean it's a good company. Doesn't mean anything. All I'm telling you is that, like, watch for trash stocks. Any trash stock going into the New Year's, they might have a sympathy bounce when people are done selling, and then you can exit out on a trade. So watch them for trades. This at least is very volatile. So a lot of solar stocks are. And then you'll have to look at lithium too, because lithium is now done. Because China, the stimulus, burp, 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 not exciting. So that means a lot of the EV stocks that were dependent on China, everything else related to it, like lithium, yeah, that's going downhill. Bop, bop, bop. So we're done. So this initial pump up right here on China stimulus, it's over. You see that? And the one last retreat up, that's done. Elections finished. So, I think the last I heard for the House elections, I think they're going to retain control of the House. So GOP is retaining control of the House. They got control of the Senate now. They got control of the presidency. For the next 2 years at least, it's all about Republican spending. So who are the Republicans going to spend on? Prisons. Apparently. Man, I should have knew. So this thing up 42% on the elections, up another 13% on earnings. For the whole week, this thing is up 76%. Damn. Oh, man. I don't know if Michael Burry still owns this dang thing. But anyway. See how high we're going to go here. Yeah, we're back up to old highs from 2015. Not sure how much further it will go. But yeah, I'll keep it on watch. You never know. It might retrace 50% of this, right? It'll go back to 17. So let's say people start selling it off. So they'll try to hold it into New Year's, but I doubt it. I'm going to assume some people are going to start selling. And then by the time New Year's hits, there'll be a whole bunch more sellers because they're like, okay, whatever. We got to get our profits before we lose all of it. Then we'll hit around here, $17 a share, $15 a share for Geo. Look for that. I'll probably be like, yeah, maybe that's a time to think about buying, and then we'll see how it goes for the next 2 years after that. All right. Keep that on your watch list. Let's see. Other one, AAOI. Yes, this is the stock I was saying. Gamble, gamble, gamble. It's great for gambling, not for investing. CEO is really terrible. The CTO is some lackey. This thing probably is running on one customer only still. I haven't looked at its earnings call, but I assume it's the same way it was in 2018. This is a one customer stock. When that customer buys, it will get it. Optical cables for data centers. And what's good is that when you see trash like this get a lot of buying because they are a one customer company, you look at the broad index, I mean the broader sector. We'll look at Lumentum. They reported yesterday too, also up. Good sign. And then Core, COHR, above its resistance and support level here, right off of earnings this week as well. So Lumentum is LITE, light. Okay, so keep that in mind. So what that means is it tells me that AI spending is still strong. Data center spending is still strong. And doesn't mean that semiconductors itself are going to do well, because that's going to be really dependent on NVIDIA right now. NVIDIA won't report for 2 weeks on the 20th. Okay, so same thing that I'm playing with SMCI right now that I told you guys, like, yeah, if you get into 20, really good. If you got at 28, 25, yeah, you can keep holding it and see what happens. Okay, so my 28, 25 holds, I still have them, and I sold my 20 to 25 position there, so I'm holding the rest, see what happens, see if I can get 40, then I'll sell the rest. That's it. That's the game plan. Okay, guys, for SMCI. And you can go back to the previous video on SMCI to see what Martin Shkreli said. Now, the other thing to look at is gold and silver. Like I said, it's going sideways. So that's what I was warning you guys about that. As you can see, like, yeah, we are probably going to have this holding pattern. I'll play a silver video later on to discuss more about silver. He'll analyze the charts for silver for you, the actual metal itself. But EXK, the miner, and for silver. And then I also recommended KGC. After what I saw earnings this week, I saw the way it reacted. Like, look at this. You see that dip after the earnings and elections, and then right away you get a bounce. Very strong. Very strong. So for gold mining, KGC, keep that on your watch list. We'll see. But yeah, expect it to go sideways from here. We won't see any movement probably until next year. That's my guess. What I see is bonds at least are trying to go back to where it broke. Very good sign. Because one of the problems is that if bonds are sold off too strongly, people are not going to be interested in gold and silver, because gold and silver doesn't pay interest. So when you see bonds get sold off, new buyers of bonds, they'll look at the bonds more interested for 30-year, right? They'll look at the 30-year and be like, the long bonds, they'll be like, whoa, man, I could get a 30-year for 4 or 5% again. Shoot. I'll just use my money to buy a bunch of 30-year bonds. They won't look at silver and gold anymore. They probably already have enough gold and silver, because so you have to understand the way the money flows is based on the big money, right? They control where the price is, not small buyers. All you guys going to Costco buying a bunch of bars of gold, that ain't influencing shit. Okay? That ain't influencing nothing. All right, that nothing. All that does is it'll influence the liquidity when you buy and sell, at your jewelry store or pawn shop, or if you go online, they got AMP, right? Ampex or whatever that website is that most people go to. Yeah, but otherwise the premiums when you buy and sell pieces of gold. But for the actual movement in price, the big money, it's really dependent on bonds. So even if inflation is going up, or if inflation is staying sticky, they won't touch it, okay? Because if the bond prices start getting attractive to them, they'll rather get bonds. Because I could buy TMF, I could buy this ETF right here. I could take my money, buy this ETF, TMF, right, and get it at 40 something. Expecting it to sell it at 58, and I'll get my 3-4% just holding this ETF at the same time, right? That's 3 or 4% APY. So over 1 year, it's 3-4%. That's a good deal. If I get gold and silver, I don't get any interest from that. So you got to understand, there's a competing action between different asset classes, right? Bonds and gold actually compete against each other. Okay. So there's nothing that works in isolation. Stocks will fight with bonds. Bonds will fight with stocks and precious metals. Okay, that's it. And now we have a new entry in with crypto. Crypto is still a small market. It's not that big yet. It won't have that much influence. But over time, it may come into question. Should I buy crypto versus precious metals versus bonds versus stocks? Everybody's fighting each other. And then you also have the FX effect, where like people are like, oh, I have to run into dollars. Because one problem with having gold and silver is like there's no liquidity. You know what I mean? You just can't run around with bars of gold and silver and going up to someone and like, I want to buy your house. The liquidity is only in dollars, especially when dollars are essentially digital at this point. Nobody's carrying around wheelbarrows full of cash, right? The banking system ensures that there's liquidity in the cash system, where cash is essentially a number on a computer screen. So until Bitcoin is accepted and their network is accepted, that's where the issue is, because I could potentially see crypto unseat that banking power, right? That's the dream. That's what the pipe dream is for the Bitcoin maximalists. So I'm just giving you the fundamental reasons there. But as far as this show is concerned, we're just trading right now. So we'll just look at it, right? So Bitcoin is still holding. We're still holding up pretty well. So I wouldn't worry too much about that. I don't see any issue right now. Just keep watching it into next year. But yeah, look at crypto mining stocks. Go back to the previous stream. I go over some of them. I'll go over some of them again next week if I see anything different. But be aware. Put them on your watch list. If you haven't got any yet, if you already have some here, you bought some already at the bottom of this range, prepare to buy more. Just prepare to buy more. That's it. There was an issue with CLSK today. The trading got halted because they had some issues with the warrant conversion when they did the merge. So there was a clerical error. I don't know what's going on. So pay attention to CLSK on Monday, because I don't know what this error issue is, if it's going to have a bad effect on Monday. So if you get people panicking and selling this irrationally, you might be able to get a good entry at $11. All right. So watch CLSK on Monday. I don't know what this filing issue is and how much effect it has. They put a press release saying they didn't do any fraudulent whatever. I don't got time for another SCMI situation. Okay, if you remember, SMCI situation. I mean, so yeah, watch this one, SMCI, for the next 2 weeks. Watch the crypto miners into the end of this month. So if you guys didn't get any yet, or if you're waiting to add more, yes, hold on. Don't rush into it. Bitcoin is at a new all-time high. We're not going to get there. The other stock to talk about is Tesla. Beautiful. This is what I want to see. I want to see this breakout of this last region, the last region before coming to the boss here. We got to, yeah, you basically broke everything. Perfect. Bam, bam, bam. So I'm going to go over my price projections, okay, for this stock as an example towards the end of this video. So come back to the end of this video and I'll do this. So you can skip ahead if you're really interested in Tesla. So yeah, this is perfect. Beautiful chart. Beautiful. Perfect breakout here. Yeah, so after the elections, and it keeps going up like this. So it opens right at the resistance, pops up. Perfect. Yeah, that's great. This is really great. So we'll see. And last one. I think I covered AOI. MindMed. Yes, this one. I love this one. This is one of them mushroom acid psychedelic companies. So they had FDA approval here for their medicine for depression, essentially, right here in March. And I've been eyeing it, like getting in here at 5. Perfect. You get into this region. So you see this red bar is the largest of the bars that when it went down. So it's very significant. And then when it went through, so this was the day before the announcement of the FDA. So somebody already knew, right? You see the movement here? You see the way it is? You see the way it's acting? It's already pushing up towards that resistance. So people already knew what was coming down the pipeline. They were just eating it up right there. And once the news broke, pop. And then they were selling right here. And that's why it moved back down, because all the people that were buying here, they got the news, they got their money, they're done, they're selling. This is distribution, right? You see this accumulation, and then you see more of it here. So people were just really starting to get the news ahead of time. And then once it comes through, it's done. They're done. So this was the last failed attempt to retake like 50%, and then it falls back down. So anything with a significant bar, just look at the 50%. Now you see this weekly candle right after earnings, right there. We're just above that 50% mark here too. What I feel is like it will just go back and fill this area in the 7 and 8 area, and then once we're done with that, we're ready to try to attack 12 again. And once we get through 12, we get to 36. So yeah, keep this on your watch list. MNMD. I think this is a great potential multi-bagger stock. Risky penny stock type thing, but hey, so like I said, AOI, MNMD, anything like this, like you're really interested in very volatile stocks, or you're interested in something that might be long-term, MNMD is actually a better story, for the longer term, especially for your IRA, accounts where you just have very little cash in there. This is perfect. You can easily like quadruple or quintuple your account size using stocks like these. So this is one of them. I'll probably have to look for more, since a lot of people will be more interested in this. I don't personally partake in so many, of these type of risky stocks, but when you see charts that really align very well, and then if you have a fundamental reason on top of it, or a potential fundamental reason, yeah, they're really great. Okay, guys, let's do another video. Let's take a break from charts. Look at another video. I think we're going to talk about stimulus. American stimulus. So Chinese stimulus has failed. Chinese stocks are coming back down. But let's see what the American side has for us. What do the Americans think?
CEO Arvind Krishna joins me now. It's good to see you.
Always good to see you, Sarah.
Well, everybody's rethinking the entire outlook because of the election. How does your view change of what's ahead?
Look, I think taking uncertainty away always helps business. So now we know what we have in terms of roughly. We don't know the exact shape, but we know roughly where U.S. policy will be. I think it is going to lean in favor of innovation. It's going to lean in favor of economic growth. The president-elect has been very clear about that. And I think that's what this nation is founded on. So that, I think, is going to cause tailwinds to spending, both CapEx as well as technology spend.
So you see an improved picture for your own business?
Absolutely. I think 2025 is going to be better than 2024.
Does that include the consulting business? That was one of the weaker spots in the last quarter. And you were talking about it's not a quick fix when it comes to the discretionary spending from companies.
Yeah. So when I look at the last quarter, I would actually turn around and tell you, I think it showed that the underlying health of the business was extremely good. We grew software at 10%, and consulting was soft. Consulting was flat as opposed to 2, 3, 4% growth, which is what we might have expected. Yes, that comes from people pushing the brakes slightly on discretionary spend. But why? We said we think that's because partly uncertainty, partly geopolitics, partly interest rates and inflation. So if 2 of those 4 get moderated, then that implies that people are going to spend. I also think if interest rates stay moderately higher, then technology becomes a way for people to get their way out of the other costs that come with it. And that, I think, is going to drive tailwinds in 2025. It's always hard to predict by the month, but I'm actually optimistic that we'll see a turnaround there during the year.
During next year,
during 25.
early next year. What about regulation? I mean, you've talked about how everybody's looking forward to a more deregulatory environment, at least in the market. How does that affect your sector in particular and your business?
Look, I mean, we always need regulation. So let me acknowledge that. Regulation provides guardrails. And this goes back to the very foundations of capitalism, where you say, yep, you need the market to be free, but you need to provide some guardrails so that you don't get bad actors. So we'll acknowledge that. But regulation creates friction. If you give too much friction, as when regulation becomes overzealous, it causes a pause. It causes a massive slowdown, which none of us want, because then the economic growth is not there to propel the economy forward. And I think that that may have been a little bit of where we went. So I think that a lighter touch on regulation is going to be extremely beneficial to business. And that means in the end for citizens, employees, and the nation.
Does that include M&A, antitrust regulation? That's where it's been particularly tough in the Biden administration. A lot of people are looking at you to see what your appetite would be to do deals in a different regulatory environment.
Look, if we can get certainty that deals can get done in a certain amount of time, where there's a conversation between the regulators and the business for them to be clear about what they want and what they don't want, then it causes an acceleration in what we can get done. By the way, that causes capital to free up, because that means companies who are private, that money goes back into the market. So I think it actually propels everything forward. From everything I can see, I would predict that M&A volumes in 25 will be quite a bit up from 24 and 23.
What about Gen AI regulation? There hasn't been much of it, but already the president-elect on the campaign has promised to overturn, for instance, the executive order from the Biden administration on AI. What do we expect?
Look, we believe in responsible AI, and we have been very public and talked about that model developers should be accountable and responsible. We want open innovation, not closed. I think the pieces where there was talk in the administration and you could interpret some of the EOs as saying that you need third-party assessment just causes, again, way too much friction when it's such an early stage. So being accountable, good. But asking for third-party assessments, I think, is not a good idea. And so we are in favor of a lighter touch on regulation, other than for some extreme use cases where it involves life and death.
Shares of your flagship fund, the ARK Innovation ETF, surged more than 8% on Wednesday. It was the best day in more than a year. Part of the risk-on trade that we saw on optimism of a second term for Donald Trump in the White House. And that's where I want to start with you, because when you were back on with us in October, you indicated, without actually saying the former president's name, that you preferred a President Trump over President Harris, strictly from the standpoint of the candidate who you saw would ease the regulatory environment. So here we are. What does another Trump administration mean for you and the companies that ARK invests in?
Okay, well, thank you for having me on your show, Tim. Yes, regulation, critical. I think the regulations that have been creeping into the system, actually, they started to creep in. They've just flooded the system and really gummed it up. So the biggest regulatory issues have been around the SEC, especially when it comes to digital assets or crypto legislation, and the FTC as it relates to M&A activity. I think both there are going to be big changes there. And that is going to be the beginning, I think, of a lot of regulatory changes. In his first administration, President Trump basically said, for every regulation you want to introduce, anyone in my administration, you must get rid of two. I think it's going to be maybe more dramatic than that this time around. And I also think having Elon Musk, who I think today announced that he'd like to name a new department, the Department of Government Efficiency, get that, D-O-G-E, Doge. I think he's going to come into the administration. I don't think he'll be a formal part of the administration. He'll be more in an oversight role, as I understand. Yeah.
Well, hey, Kathy, I want to jump in here because you mentioned a few things that I want to follow up on. One is Elon Musk. Have you talked to Elon since the election?
No, I have not talked to him since the election. I did see on X that he was part of the family as they were taking the picture around President Trump's acceptance speech. So, you know, I know he's obviously had a tremendous impact on the election. I think he had X made a big difference, and his ideas around government efficiency, which will revolve importantly around technology. Artificial intelligence is doing wonders for the most bureaucratic organizations out there. We know from Palantir that it is having a tremendous impact on insurance companies, underwriting process timelines dropping from 2 weeks to 3 hours. And even in the military, Maven, Palantir's working on Maven with the DoD for targeting the enemy. They have shrunk that department. Don't need as many people. They've gone from 2,000 to 20 people.
Right.
Which it's pretty amazing what's going on. And I think we'll see a lot of attrition. Any employee leaving the government probably will not be replaced.
Okay.
I don't think he'll. I don't think he'll do $2 trillion in government spending savings in 1 year. That might be a 5 to 10 year. And I think between technology and attrition and lower regulations, maybe the abolition of certain departments, that they'll go a long way.
So you don't see him serving a formal role, but still overseeing some sort of Department of Government Efficiency in an informal way? Help me understand what you see him doing, and whether or not that could be some sort of threat to, you know, he's a very busy man.
Yes, he's an unbelievable, he's the inventor of our age. I think I said that in 2015 for the first time when I was on your show with Carol Masser at the time. He is the inventor of our age, and he comes into a problem, assesses it with first principles thinking, doesn't care how things have been done, and comes back with, you know, ingenious solutions to big problems, whether it's autonomous mobility in the autonomous taxi space, or in the healthcare space, Neuralink. He's in the social network space, X, in AI, XAI, but and a lot of people say, and SpaceX, of course, the entire exploration, going to Mars. I think a lot of people are can't believe he can do this, but again, he cuts to the quick. And first principles thinking, and surrounds himself with brilliant people who really want to solve the hardest problems in the world. And that's part of the secret to his success. Very high standards, and people who want to be held accountable to very high standards and want to really transform the world.
Hey, we're going to get back to Elon and specifically Tesla in a few minutes, but I want to go back to something that you mentioned at the top of our interview, Kathy, and that's the idea of some of the regulatory challenges that you said have cropped up over the last couple of years and during the Biden administration, specifically with regard to the FTC and the SEC not being present in a second Trump administration. How do you think the Trump regime will approach financial regulation, given that he's vowed to replace SEC Chair Gary Gensler? What does that look like?
Well, I think first, as it relates to crypto or digital asset regulation, they're going to replace Gary Gensler with someone who is much more open-minded, I would say, and will let the legislative process go to work. And, you know, the SEC is supposed to regulate, enforce laws. They're not supposed to create laws by enforcement, which is what Gary Gensler was doing. So I think that's going to be important. I also think if you look at the public equity markets, I think the number of public companies out there right now has been cut in half in the last 15, 20 years. The regulatory nightmare of being a public company has kept leaders of companies basically saying, if I don't have to go public, I am not going public. And so I think we're going to see a lot more work in that regard to give, the average investor a shot at some of these moonshots. So I think that's going to become very important. As far as the FTC, the antitrust has gone way too far. They were denying mergers and acquisitions that really the companies were tangential to one another. They weren't even really in the same market. So we're seeing, and yet at the same time, we've seen these megatech companies grow into, massive organizations and dominating their market. So they were denying mergers and acquisitions for, think about JetBlue and Spirit Airlines.
Yeah.
That was ridiculous. That was in the same industry, but one is going bankrupt now because they wouldn't allow that M&A. They were just dogmatic about it and didn't show to us at least any common sense.
Alrighty, you heard that. Casino is open. We're gonna get more mergers and acquisitions. This is really good. So that's M&A, very important for one sector, biotech. Any pharmaceutical company that's wanting to buy each other out, this is where it's at. Biotech is the most. So Kathy Wood's ETF, ARC, up 15% this week. After the elections, we are now entering right back into this cyan region. ARC's ETF was the darling of Wall Street since COVID. What happened? Well, interest rates went back up. Jerome Powell stopped the liquidity, free money printing machine, goes all the way back down. We've been crawling since 2022, crawling slowly, ever slowly, right back up. Now we got Donald Trump in the house, the Fed ready to cut rates. Guess what? Bubble time, bubble time, bubble time. So when you see this ETF start going from 50, going all the way back to 150, it's time to look for stocks, man. It's time to look for trash stocks, any kind of stock. So what kind of stocks I like? MindMed, MNMD, looking ready to fly. It was crawling around $2. It's back at $8, $9, going to go to 12. But the real prize is $50, $60, $70. So this is what the conditions are. I don't care about the fundamentals. I have no idea if this will ever be a successful company. But when the liquidity is ready, that's when stocks in ARC and whatever. And remember, ARC was the one that sold a bunch of Palantir shares at the bottom. These guys, she doesn't really know how to time, man. Timing is all about astrology, is all about looking at cycles. If you understand market cycles, you really can do it really well. All she cares about is just acquiring companies wherever they are. Just buying any company at any price is not going to be successful. You got to know when to buy. When to buy is more important. So now that we know what the cycles look like, we see the bubbles, we see the action. We're ready to go into another stage. Probably 1 year at least, maybe 2 years if we're lucky. And then 2026, we can wait for a financial crisis, because I assume a real estate or financial crisis will occur again sometime there. You should see real estate prices really boom. So if we're going to look at real estate, keep an eye on home construction. So first home buyers will tend to buy newly built homes. These companies, these developers try to offset prices and interest rates with deals. So if you got good credit, they'll try to sweeten the deal, with it. Also look at banks for lending. So KRE, regional banks up. So if lending is nice, if we get a good curve in the interest rate, so it's an interest rate curve, not just one interest rate, the interest rate across the whole spectrum, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, 15 year, 30 year loans, the whole spectrum is aligned correctly and lending is good. The money printing machine is in perfect order, then growth can be sustained. So that's where the growth engine comes from. It comes from the loans. The Federal Reserve just sets the initial interest rate to the bank loaning system. So banks will loan it to each other at a certain interest rate set by the Fed, or they will set the interest rates if the banks need to get a loan from the Fed itself. But from that will be given the interest rates for everyone else in the public. And this is where it's at. Look at that. I just drew right there. I just showed you. I just drew a line from January 18th. I just eyeballed it. I said, like, this is a top. There's another top. And look at that. Look at that. So regional banking, that green candle just envelops this whole range. Perfect. And this area here, this drop was due to the SVB bank run. So when all those techies were just like running out of that bank for some unknown reason, I think they just text each other overnight and said, like, I'm pulling my money out, and everybody else, all their friends start pulling their money out, caused this local crisis here. So this was a liquidity crisis. Just like COVID, you have a liquidity crisis where people are just panicking. People are panicking. You have this kind of effect. So as long as there's good liquidity, prices go up. They tend to go up in stocks, all right, in assets. So this is what we have to look at. Now, let's see what other things to talk about. I was going to discuss. Okay, we covered that. Affirm, yeah, Affirm had earnings. I don't know. I don't think it's that important, Affirm. Yeah, but I had this video to play for it. I don't know. It's in the top of its range. I see this movement. Earnings reaction wasn't good, but I'm going to continue watching to see how it goes. This was one of 777's recommended stocks. So I don't know. I don't know if he recommended this one and Chevron, I think. You know, my two stocks were Axon and Palantir. So I think I'm still the king of picking stocks, but you know, Affirm ain't bad. Yeah. I mean, if you bought here 25 to 45, that's still 100%. That ain't bad. That ain't bad. But the chart needs a lot more work. You see, you make this little cup pattern here. I mean, I like that. I like it did this. I like that it fell and made this creek pattern. That's what the Wyckoff guys would call a creek. So definitely, if you guys didn't do your homework, you should do your homework. Here, I'll put the link in the chat. You go to the link and do your homework and read the papers. Okay, let's see. Oh, damn. They privated it. Shoot. Oh, they just privated it. Oh, well. You can't get the old stuff, I guess. Some of the old stuff. Yeah, that's lame. Okay. Okay, well. I mean, they have the new website, but I don't know like how much of the stuff was saved in the old website that they didn't put in the new website. But anyway. Yeah, I should have downloaded it then. see here. I saw on Godell that Martin said if you're holding PLNT, you might tell you, what do you think? I don't know. I mean, it's nothing. I don't think there's any reason like to keep it. If you already made a lot of profit, you should always sell once you hit your targets. Like once you break new resistance, because right now it's above the past resistance when it had the the SPAC pump, initial SPAC pump or IPO pump. So yeah, I mean, I would be selling too. Why not? But if you have a tax issue where you don't want to sell because you're going to get short-term gains, then yeah, because you're not going to get the long-term capital gains treatment, right? So then that's also an issue. I don't know. Some people with this, they'll hold the stock and they'll just sell options on it, right? That's one way to do things. So here, go here and get your homework. Read that. I don't know. So their old website, which had a lot of nice stuff on there, is gone now. That sucks. That really sucks. I don't know if I downloaded some of those things. Wyckoff, structural. Yeah, I downloaded some of it, but I didn't download all of it. Oh, man, that sucks. Oh, man, they privated it. Maybe too many people came on there. Maybe I sent too many of you guys on there. They started seeing like too much traffic, and then they started shutting their old website because they forgot that they had an old website. Oh man, shoot. Yeah. Well, let me see. Because yeah, they have a new website, but some of that old stuff on their old website might have interesting things. So, but here I'll give you the new website, so just in case there's no overlap. So I don't know if you got anything on from the old website. That yeah, keep that. Here's the new website. Crack, with the advancement of this 4B stuff, what is a good long-term ticker for femcell futurism? What is this 4B stuff I keep hearing about? What is this? What 4B? Man, what the heck? Man, what? Why I keep hearing this stuff from? Like, what is femcell futurism? What the fuck? Femcell futurism? Oh, do I have to make a new ETF? I mean, there's the white girl ETF, right? Apple, Ulta, Lululemon. What's the 4B stuff? Do I have to look? Oh man, I don't got time, man. Okay, the 4Bs. Yeah, the radical feminist movement originated in South Korea. No sex with men, no giving birth, no dating men, no marriage. You know what? Oh, that's a perfect ticker. Yeah, FMCL. So if I'm gonna make an ETF, there you go. I'll just do this. Killer boxed wine, artificial wombs. Yeah. The funny thing is, like, you can go to the Hims website. Have you ever checked out the Hims and Hers website? Pretty interesting stuff. And just check out their YouTube channel too. So there's the HIMS website. Go there. The HIMS. There's an investor website, and so let me look at where the HIMS and Hers YouTube. Yeah, here's the YouTube channel to check out all the videos there. It's like they do all kinds of strange fertility and all kinds of stuff. Check it out. Go to that YouTube channel. Like they got issues. I didn't know like your ejaculate can go back up into your like go back to your prostate. Apparently, that's a real big problem. So they got cures for that too over there. You know, we got something going on here. So let's look at the HIMS stock. So HIMS is bouncing up and down today. Like, look at this. Man, it's really trying to stay close to that resistance. You know, HIMS, oh man. So anybody that bought an 18, good job. You did a good job going through earnings and Donald Trump and all this GOP crap. But, you know, once it's building its energy, I think we're ready to fly. We're ready to fly at 24. The next time it tries to penetrate through 24, like with a strong candle, that's what you want to see. So when you look at Tesla, like here, you look at Tesla, right? That's exactly what you see. You don't want to see any goofing off and coming back down. You're punching right through it. And if you do come back down, you just retest it softly. So this whole range, you go 50% of this range from here to here. You just hang around 304, 305, and then that's it. That means you're getting ready to go back up again. You don't want something where it just like pops and then immediately it just rejects it. That's like a failed breakout. You know, you see that kind of stuff, you get a failed breakout. And you saw that in 2022 with IWM. You saw that right away. Like you can see it like here. On the weekly chart, you see this? You have this strong break, and then immediately you just retreat. The next week, okay, it's a little red, but then the next one you fall through more than 50% of this green bar. And then over, right? After that was Omicron. The Fed was talking, and then it just completely wiped that out. That's over. When you have a breakout and then you fail, that means you're going way lower. This is worse than if you never broke out at all. If you just hung around this line and just stayed below it without ever breaking out like that, like you have a strong breakout and immediately retreat, it's done. You're done. You're toast. That's more than likely that you'll just go way lower than the range you just built. So it built this range since March of 2021, and then you do that. That's so like when you look at these things, you can see the signals right away, and it's really important to look at different sectors. Like you look at IWM, it's really important. Actually, do I have a video? I think I have a video talking about this. Yeah, I have several. I think I have several. Okay. I want to download Acon. What do you think? What's Acon? Acon. Man, did Acon make an app or something? I just know the singer Acon. Did he make an app? I mean, I know he tried to build a city in Senegal, right? Akon City, like Wakanda. Did he try to build Wakanda? Like, is he successful? I don't know. Oh shoot! I almost talked about Acorn. Acorn. Oh, Acorn. I don't know what that is. Acorn. Acorn. I don't know what that is. What's Acorn? What's Acorn? Is that a software company? I just see software company. Never tried it. Never tried it, bro. I see that Irvine. It's from Irvine. All right. Micro investing. All right. No, I haven't tried it. No, I'll look into it. So a lot of micro investing, huh? All right. Interesting. Micro investing is turning into a big thing. Especially if crypto gets far. Yeah, micro investing, something I probably would be looking into too. Yeah. Anywho. Okay, getting sidetracked. Let me show you this. Since you talked about the IWN, because I do have a bunch of videos. 2 videos, in fact, small ones. There's little clips, okay? So this is really quick. It's for the ADD generation. 10 cents left over and invest them. Oh, I see. It's kind of like the Affirm with the buy now, pay later. Like there's a lot of this microfinancing and newfangled loan ideas that people are doing. I see. Yeah. Invest those extra cents. Yeah, I see. Okay. Okay, let me show you. So we were talking about the IWM, the Russell. Okay, that's the Russell 2000. Here's 2 videos about it.
This is a beauty in terms of the chart reading. We reversed the last attempt to go up that has elements of the supply. The extension is not that great. Demand is coming in the tails right away and the elevated volume. Attempt to go up, then we attempting to go down, smack down into the support, right? We can't really commit. The volume is increasing, suggesting that there is a hidden demand. And then here we see the improvement in all of those bars. And yesterday bar is a reversal bar, much better than on other indices on lower volume. So again, ease of movement, commitment up, suggesting that we're going to continue to go up after this horizontal reaction, after this verticality, and after this verticality. Yeah. This is David Wise's hugging of the resistance, and then this is just an outcome.
This is pretty important here. Yeah, so it went over a lot really quickly. But if you replay this, you can see a lot of this ideas from the Wyckoff. David Weiss, he mentioned David Weiss. Yeah, David Weiss wrote a book, the Wyckoff teacher, the main teacher, Roman. He learned from David Weiss. And David Weiss is dead now. Like he died a few years ago. But yeah, he wrote a book called Trades About to Happen. I believe that was the book. It's a pretty complex book. I wouldn't tend to recommend like reading that. It's really complicated. But yeah, it was called Trades About to Happen. Yeah, Trades About to Happen. I'm right. But he mentions that here is hugging the resistance. You see that? And you see he drew like these lines going down. You kind of look at the strides of how they go down. And then if you look at the volume profile, so you combine the volume with the way it's swinging up and down. Yeah, you can tell like there is hidden demand or hidden supply and things like that. And you can kind of assume, okay, this is where it's likely to go. You know, this is how these Wyckoff guys do it. So you don't see any indicators, right? They're not doing any indicators. They're not doing any moving average even. They're not even doing that stuff. They're just looking purely at the candles, the swings, and the volume. That's all they're doing. So that's what David Weiss was mostly about. And you can look up his name. So David Weiss. So you can look it up. You can go Google his name. Go to YouTube and Google his name. He did a lot of presentations. But yeah, he's pretty dry though. I don't think a lot of people would be really into it unless they love looking at charts all the time. But he did a lot of presentations. He also did some on he used to be a guy that followed what they call that stuff. Oh, man, I forgot. It's one of the really astrology type things where they just look at those counts. What did they call them? Counts? Like, man, those guys were ridiculous. Always like these counts. There was this charting system where they just, what do they call it? Man, how did I forget the name? They call them waves. I forgot what they called them. The waves. Oh yeah, Elliott wave. That's what it was. Okay, I looked it up. Elliott wave. So he used to do Elliott wave too, but then he gave up on that. So I think he mostly sticks with Wyckoff stuff. And if you will go more further, you can learn about DeMark. So I mentioned DeMark before. DeMark. So you can look up Tom DeMark, and this dude is even more advanced than that. So look at Tom DeMark. Go Google it. Google it. Go find some YouTube videos on it. I played a few. So I'm going to replay this one. Let's see if you catch it.
Tails right away in the elevated volume. Attempt to go up, then we attempting to go down, smack down into the support, right? We can't really commit. The volume is increasing, suggesting that there is a hidden demand. And then here we see the improvement in all of those bars, and yesterday bar is a reversal bar, much better than on other indices on lower volume. So again, ease of movement, commitment up, suggesting that we're going to continue to go up after this horizontal reaction, after this verticality, and after this verticality. Yeah. This is David Wise's hugging of the resistance.
David Weiss's hugging of the resistance. So yeah, this is beautiful way of looking at it. I really like people when they look at it like this. I'm not that good. I can't tell you, But hey, I mean, like, the more you learn about reading charts, the better you are. Now, there's a lot of ways that are just too simplistic. If you just Google a bunch of stuff and technical analysis, you just learn the basic stuff, which don't work. It don't work for one major reason. Everybody knows about it. Once everybody does the same thing, they're doing the same trades. That's when they stop working. The only way you're going to make good trades now is you're doing something that most people will not do, right? And so the stuff I'm teaching you is not exactly secret either, but at least it's more rare to learn it the way I'm telling you. And the more rare, the better. Now, I'm thinking that when you combine all the stuff, techniques into one, where I teach you the multi-time frame technique from Joe Rabel, the Wyckoff method, right? Learning through just looking at candlesticks and volume. And then you add on top of that DeMark. And DeMark is the last piece, is the most difficult piece. If you add all three together, that's really, you will become a master chart reader. Then what you want to do at that point is try to take that knowledge and somehow get artificial intelligence to do that, because all you're doing is reading an image. If you're just reading patterns and images, you can train AI to do the same thing. But at that point, you don't want to tell people what you're doing. You got to keep it hidden. You can't, after this, I can't tell anybody anymore. I'm just giving you the seeds right here. I'm just giving you the little nuggets. You can do this yourself. If one of you guys go off on your own and take what I've told you where to go look at yourself, you can make tons of money, probably real easy. It'll just be a printer. Beep, 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 beep. But just don't tell anyone else, Keep it a secret. Like, once the secret is leaked and like 100 people know, it's over, right? Because those 100 people will talk to 1,000 people, talk to 100,000 people. It's done. It's done. So you got to keep a cabal, all right? You got to keep it. That's what it is, right? It's the Illuminati. You got to have that secret handshake. You ain't telling everybody about this shit. Hell no. That's why AI to me is pretty scary, because a lot of this stuff, a lot of trading I'm teaching you right now, look how easy it is. All I'm doing is looking at a picture on a screen. Like, I'm not wasting my time like Shkreli and like autistically looking at every balance sheet going like, how much is gross income? How much of this is like revenue stream is here? You think I got time for that shit? I don't even care about that shit, because it's a waste of time. Everybody is doing that. Like, you think Shkreli is doing something that another person isn't doing? There's a billion suckers in a bank building right now doing exactly what Shkreli is doing. And you think Shkreli, one dude, can take a bunch of Adderall and Coke and meth and outdo 100,000 sucker MBA guys that are getting like 60K a year to do the same thing as Shkreli is doing? No way. And AI is going to replace them all anyway. But if you get AI to look at cycles and look at charts, you're basically stealing their work on top of looking at something better, predicting the future. Predicting the future isn't going to be told from financial statements. They're going to be told by astrology. That's the key. Astrology is the key. So anyhow, okay, I'm getting off my soapbox. Don't worry. Let me play this one. Let me play this. Let me play this video. There's a Friday soapbox. Yeah, here we go. So after you saw that chart, look at this.
Look how muted this reaction is. It just comes down to this bar here. We come up here. We spoke about the attack to come and break through these highs. Look at the volume. We knew we was going to have a reaction here. We do have a reaction, and we hold another higher low, Roman. And I like your observation of this volume coming in here. That's hidden demand. The secret buying here. Why, with all this effort to come down, can we not even go and test this support? It's additional strength. And higher low, or low, higher low, higher low, higher low. And now we push on, break through. And look how we're breaking through resistance. As you rightly said, takes equal or greater volume to break through a resistance area, and that is not retail buying, right? That's institutional buying. We spoke about this being very strong.
So yeah, you can go to their website. You see it there. Wyckoff Analytics. I mean, it's a very expensive course. I haven't taken it myself. But I think from what I've seen, how they teach people this stuff, it's very useful. But you got to be really serious. It's probably a waste of money if you just come in there. You're not going to be serious. You're not going to do the homework that they do in one quarter. Like they treat it like an actual college course, because it was a college course in Golden Gate University in San Francisco at one point. So yeah, you got to be really serious. But I don't think you have to be. You can be a normal trader and still do a lot better than most people. And I've shown you this already. Like, all I'm using is a moving average, right? 2 moving averages, 40, simple moving average, 18, and you can do a lot with it. So I think
this is just an outcome.
Yeah, okay. Let me get the. There's gonna be another videos I'm gonna show. Oh yeah. Let me see if that's on the list to play. Yeah, it's not on the list to play, but I'll play this anyway because we're doing the Russell. Yeah, let me play this one. It's not on the list. It's not on my list to play, but this one's important.
Now on the markets, Tom Lee, head of research at Fundstrat Global Advisors, chief investment officer at Fundstrat Capital, and the list goes on and on. Annie's a CNBC contributor, first post-election appearance that we've had. You knew Trump was going to win.
Well,
not many people did.
Yes, that's.
I'll give you credit. Are you saying you didn't? Maybe you didn't say it in so many words, but you said it.
Yes, I'd say that we were placing a lot more weight on what the betting markets were pointing to, and so and we, when we look at all the deltas, that's.
And you saw it in the Trump trade,
yes.
And you saw it in Bitcoin.
Correct.
And you saw it in sectors of the market that would benefit from.
That's right.
Presumably, but who knows from a Trump presidency. So 1,500 points a meet out of the gate. More to come, or are we're already there?
I think we need to respect this move. I mean, there was a tremendous rally post-election, and it continued yesterday. I think it really does reflect a lot of money was taken out of the market because of the uncertainty around the election. And now we know that because of policy changes and animal spirits, that this is really going to benefit things like Bitcoin and small caps and regional banks and financials. So I do think there's still a lot of upside. I mean, small caps trade at 10 times median forward earnings. I mean, that's a...
So what do you think that should be? 12 times? And what's the opportunity set in your mind?
Well, since 1987, small caps traded on a median PE basis at a premium to the S&P. The S&P is at 17 times. So I think small caps could, in the next couple years, outperform by more than 100%.
And what do you think about some of the macro issues that I think create a different level of uncertainty? We keep talking about the bond market and what that might be saying, what you think is happening with gold. Are the bond vigilantes going to be this governor on whatever you think is going to happen in Washington?
As James Carville famously said, the bond market is, everyone's scared of the bond market. So that is something we need to watch. But we've had plenty of periods where stocks have risen with bonds rising. And I kind of agree with Powell's assessment that it's not yields have gone up not because of inflation, but because there's sort of a change in growth expectations.
I thought that a sweep was, for either party, was the death knell for the markets and frightening to all involved. And now we're getting a sweep. Why isn't it more frightening? Maybe a sweep the other way would have been a little more frightening to some.
Yeah. I mean, I think part of the reason investors are getting somewhat optimistic is that President Trump is entering office again, but this time with a lot more knowledge of how to build a cabinet and a team. And so in some ways, this would end up being more market friendly. And I think that's why investors are becoming optimistic. I mean, I kind of agree with the idea that there are animal spirits growing.
He'll never be deficit friendly, will he? I mean, he will be deficit friendly. He won't be, if we cut taxes on tips, Social Security, overtime, remove the SALT cap, extend the tax cuts. If you do all those things, that seems like
it's going to be very difficult to fix the deficit with just changes in taxes and spending. But it's probably why Bitcoin is kind of interesting here, because it's potentially a Treasury reserve asset. And, if Bitcoin rises in price, it actually helps offset the liabilities, which is the deficit.
So you were at 150, I think, on Bitcoin, weren't you? But
yeah.
Not necessarily by the end of this year, or?
I think 6 figures is still possible before the end of the year, yeah.
And then more next year and the year after?
Yeah, I think because now, post-halving and now Bitcoin's becoming a lot more relevant, and I think maybe the regulatory overhang is diminishing, that there's a lot of upside from here, yes.
Okay, S&P, end of next year.
Well, between now and year end, 5 to 10% is probably the base case, just because that's the type of rally post-election, and we have a dovish Fed and, the normal seasonals.
Is that the right move right now for the Fed?
I think inflation fighting war is largely over, and the real rate is still too high. So I agree with Fed's view that we need to move towards neutral, which is towards 3%. So I think it is supportive of markets, and business investment has been constrained. So I think these things are positive.
So what about 2000? What's next year? Is that 25? They move so fast. They're like months now, the years. So what about 2025? So 5 to 10% more would put us well above.
Yeah, more than 6,000 before year end. I think at least for the foreseeable future.
No recession.
No recession, and
people want you to answer when I ask you a question. So what are you saying? 60, what hundred on the S&P?
I think well past like 6,700.
No,
sometime next year.
6,700.
Yeah, sometime next year, because
that's another 20%, isn't it?
Yeah, it's maybe 10, 15. Yeah, because margin debt hasn't really risen in the last 4 months, and the stock market's up. So we know investors haven't been adding risk, and now we have earnings visibility, and we have a continued dovish Fed, and then this election's behind us. So multiple tailwinds exist.
Wow. You're pretty bullish.
I think I'm pretty positive on the U.S. and fundamentals, yes.
Okay, good.
No, what's up? Oh man. So, yeah, small caps, good. Oh, you don't know what animal spirits are? Look up George Soros. George Soros coined that term. Animal spirits. I think it was George Soros. Yeah, you guys got to know all the terminology, man. George Soros, he believes in astrology. George Soros. Let me see. George Soros. I was trying to while it was playing, I was trying to look up this video because someone went on CNBC or Bloomberg, I don't know which, and they said AI caught the accounting error of SMCI. So you see, like Mark Shkreli is like wasting his time looking through 10Ks, and all this stuff. AI can already do accounting way better. So I don't know where that video is, but it was on YouTube. It was recommended to me, so I can't find it again. But let me see. Animal spirits. Animal spirits. Who coined it? Who coined it? Yeah, it might have been his protege, right? Druckenmiller, but I'm not sure. Spirits. Oh, it actually predate both of them. Oh, it was Keynes. Keynes talked about it. Yeah, okay. Keynes talked about it. So it's Keynes. So it's all from Keynesian economics. So I can read the simple definition here. Animal spirits is a term that describes how human emotions and psychology influence financial decision making, particularly in times of economic uncertainty. The term was coined by British economist John Maynard Keynes in his 1936 book, The General Theory of Employment, Interest, and Money. Okay, there you go. Do you want to read that? But yeah, it's quite popular saying. Talk about animal spirits, and we can talk about animal spirits right now. Let's look at Mexico. So you said, right? This was a great trade doing the Trump victory. You get the dip at the open, you sell at the top of this range, and now you're back here. And guess what? We're back at the beginning. So this is the beauty of trading, is when you have these animal spirits. And you can look up this other term called reflexivity. This is how you make the big money. When people panic, when people get exuberant, and then anyhow you go back to the same price you were back in August. So the effect when Mexico had its new president, you drop all the way down into August. You hang around in this range. Trump is coming. You fall into the bottom, and you're still stuck here at this range. Why does it matter? It's just animal spirits. This is exactly how you make the big money. The big money, man. It's coming. It's coming. But you react anyway. You flip out anyway. Everybody's dumping their Mexican stocks, and you end up at the same price. You dump it, you oversell it, the shorts cover, it gets all the people are panicking going the other way because all the idiots were shorting at the low. So all the old shorts were shorting here, they got out. All the stupid idiot shorts came in here. The smart guys covered. They bought, they sold. Then you end up at the same price. That's it. That is it. That is the animal spirits. Okay? So this is the animal spirits, and you make a killing off of this, right? So if you were trading, like I mentioned this, to look at Mexico and China. So if you did a 2-day trade, 2-day quick flip, That was the game. Like, you got in here, you sold out 30%, you got out, and then you fall back. Now all you're doing is you're waiting, because now it's just Mexico versus China. Mexico versus China. Mexico is the new China. China is trying to boost their domestic consumption. If it can't do it, like right here, I would be looking into Chinese stocks next week when we have earnings. So look at Baba. You gotta look at Baba. When does it have earnings? Thursday, right? Oh, it's Friday now? All right, Friday. Okay. JD, probably Tuesday, right? No, it's a Thursday. Okay, fine. Then what else? Who's the early bird? Billy? Is it Billy? No, not Billy. Is it Baidu? How about Baidu? Which one? Baidu. What the heck ticker is that? Okay. Oh man, it's way too late. Come on, I'm not gonna wait till 21st. Anyway, yeah, let's see how they go next week. I'll be looking to buy some trash, get some things to get. I mean, well, Gary, and I mean, expensive is a relative term, right? It just depends on who's willing to buy at a higher price, right? So we're early days now. Don't worry about it. Don't worry. We're not in alt season yet. Let's look at Ethereum Classic if you want to look at crypto. What the heck is Ethereum Classic doing? Ethereum Classic. Let's see how that's doing. Okay. See, it's in a range right here. Is it going to pop? I don't know. I'll be watching that. Solana's always been doing good. That's always been a good crypto. They got a lot bigger ecosystem than most, right? So this, yeah, look at this. This has always been doing it. It's already been outperforming a lot of the altcoins for quite a while. So don't worry about this. So what we're looking at though is Core Z. Core Z had its earnings. Ooh, beautiful. So you got here at $6 in August. Now it's 16. I mean, if you were really a daredevil and got in at 3, you got 16. Very good chart. Core Z does Bitcoin mining. It does AI. It does data center stuff. So it does it all. So let's see how this one will go. So it had earnings this week. I like it. I like its chart. Wolf is another WULF. So yeah, it has a nice chart as well. Broke out of resistance. Gwyneth Paltrow's in this one. I don't know. Gwyneth Paltrow believes in a lot of weird stuff. She sticks a lot of things in her vaju. But hey, maybe she goes and talks to witches and they know what the future is. So I can't complain about $1 to $8 performance. Okay. So, but yes, it is a gamble. Do not put your whole pot in one stock like this. Just keep it in your mind, kind of like MindMed, MNMD. These stocks are kind of like maybe they might get multi-bagger, maybe they'll just crash and burn. But yeah, keep that in your mind. You can allocate some portion of your portfolio to those type of risky stocks because, as we heard from Tom Lee, Mr. Bull, you see this? This is the IWM, small caps. If the small caps are leading, what does that mean? That means risk on, baby. The garbage stocks are going to catch up to the Mag 7. Mag 7 being the QQQ, all the stuff in the FDN, ETF, FDN, Microsoft, Google, Amazon, Meta, stuff like that. Netflix, I think, is in there too. And yeah, SOX. So these are leaders, right? Semiconductors. But SOX hasn't led for quite a while. You see that? It's broken through so many support. It's still stuck there. It's still stuck back in the March levels. It hasn't even gotten. If this thing starts flying after NVIDIA, we're done. We're done, baby. That means NASDAQ is going to fly and we'll take everyone else with it. So we got a lot of, that's where the energy is. Okay. Yeah. So what else? What else is there? I think I was going to talk about Halliburton, FTF, NT. Yeah, there's a lot of earnings. FTNT. So this is cybersecurity. Very good results. This is very strong. Yeah, very strong result right here for FTNT. I don't know how the other ones are doing. Someone asked about Palo Alto Networks. Palo Alto Networks is another one. Yeah, it's okay. I think it has earnings next week, huh? Yeah, it has earnings next week at the same time as Nvidia. So I don't know. FTNT. I think there was a cybersecurity ETF. There are a couple of them. I think that one of them was called Hack. Okay, yeah, Hack. And not really much difference here. So FNTN, right? Fortinet. Yeah, FTNT. So yeah, that's a strong reaction. So we gotta look at that. So let's see what else we got here. Arista, small data center type, bad result, I guess, but still it's holding its moving average, so it might recover later on. Competitor is Cisco. I don't know if it's Cisco Systems with a Y. No, Cisco, right? With a C. Okay, Cisco Systems with a C. It has earnings next week, so we'll see. Yeah, we'll have to wait for that one. But based on the earnings we got from the optical fiber spending, yeah, it's good. It's good. So I'm going to expect this to recover. So ANET should recover. If you're in it for the long haul, like, yeah, this chart is beautiful. This is a beautiful chart. And I don't see, even with this earnings right now, yeah, I'll probably be looking to add to it later on. So this is not bad. Still not bad. Of course, it's not like an Axon or a Palantir, my favorite stocks. Oh, 600? Oh, it just hit 600. Oh, shit. Should I sell? I don't know. Palantir is like 58 right now. Yeah, should I sell? I don't know. Tropes asked me, should I sell? Yeah, I probably would sell. For me, it's long term. Okay, so for me, it's like, yeah, it's okay for me to sell. If you bought at 7 and 8, that's like, it's no problem. But if you're like HB and bought here, like, you're gonna get short term taxation. Like, so I don't know. You should sell. Maybe wait for New Year's to sell. Yeah, it's up to you guys. I can't tell you that. Honestly, yeah, Axon definitely. This is one hell of a motherfucker. I love these stocks. Oh yeah. So talking about good charts. SFM, Sprouts Farmers Market. So I don't have this one, but San Jose told me, she was like, oh man, I love shopping at this place. And I was like, oh, I do remember Sprouts because I looked at his chart at one time and I liked it. I don't have this, but if I had this, it would be in my long-term portfolio too. This is a beautiful chart. Beautiful. And it had earnings last week. Look at that. It's up 8% and still climbed up. Now it's up like 16% from that point. Shit. Beautiful. Magnificent chart. All you got to do is look at charts. But this is like the Peter Lynch style of investing. You invest in what you know. Okay? Or you know what you know about. So if somebody was like shopping a lot in this, and I don't think there's any of them that I ever went to recently, but I'm sure if I went into that store, I would see great things, a lot of selling, a lot of buying, clean aisles, good produce. You know what I mean? Like, let's compare that to Big Lots. Let's compare to Big Lots. Let's look at that stock. Let's look at trash. Big Lots. Oh, Big Lots went bankrupt or something? Because why is it in the OTC? Yeah. Go to a Big Lots. Go see what their stores look like. Like, you don't need to be an expert. Go to their stores. Look at their chart. Like, like that's all you got to do. Look at a chart. Go to the store. See how many people in the parking lots. Like, that's all you got. That's a Peter Lynch style of investing, where like you invest in what you know, right? What you're exposed to, like what you see. So, yeah, Peter Lynch. That's the Peter Lynch style. You invest in tacos. I'm sure there's a taco stock somewhere. I think Del Taco has a stock. Is it owned by Yum? I think it's owned by. Who owns Del Taco? Del Taco. Del Taco. I think there's a Del Taco. Oh man, it's no longer traded. It used to be Taco. The ticker symbol was Taco. Yeah, Del Taco. No longer traded on NASDAQ. Jack in a Box bought Del Taco in March 2022. Jack in a Box paid $12.51 a share. Sorry, HB. You missed out. There was Del Taco. Del Taco. Strong buy. Strong buy. Yeah, strong buy. It's like Bed Bath and Beyond. You know, you go to Bed Bath Beyond. I don't know if you guys ever went to that place. I go to that place. Every year, it gets worse and worse. You go there for like Black Friday. The employees look more depressed. The aisles get more empty. Like, you can't find shit you want to buy. It's just like, what the fuck? It's like, yeah, you know that thing was going to go bankrupt, man. I should have shorted it, right? I don't short stocks. That's not my philosophy in general. Okay, but if you had to, you would have. You would have. So that's just how it goes, as far as we can tell. Damn, yeah, man, it's 6 cents. Might as well $30. Just about it, like 2 years ago, $16, $17. Wow, yeah. So just looking at a chart, you know where it's gonna go. That's all it takes. Chart goes up, good company. Chart goes down, probably bad company. And you know, software companies like Palantir, they're very dangerous overall because they're very reliant on growth. And if that earnings wasn't good enough, they would have punished it pretty badly. So a lot of it. Yeah, Sprout says herbs, vitamins, minerals, toothpaste, soap. Yeah, I gotta go check one out. I don't think there's anyone near me right now. So yeah, not too many locations around me. So. But I would assume it's like it would really compete well against like Whole Foods, which is dominant. Yeah, it has a really dominating presence in California. Okay, let's see. What else? Halliburton, I looked at a little bit. Not really. Man, Rivian. Okay, yeah, Rivian. So since we're talking about like Tesla, yeah, Rivian. So earnings results came in. It dipped. It came back. Not bad. Okay. I might consider this a bottom. I'm not saying this is a good company or anything like that, especially with Trump winning. But look at that. You see this major drop in February 2024. It's holding it. So, yeah, there's potential. I do see a lot of those trucks around the Rivian, but I live in California though, so you know that doesn't mean anything. Doesn't mean they're going to have good sales or anything in the future, but it might be a good trade if it actually acts like this, where it tries to hold this area. Like, okay, you get this knee-jerk reaction after Trump, right? You see this. It drops 8% on Trump. Earnings was not good. It pulls back, but it doesn't go below 50% of this red candle. It pumps up towards the end of the day. Okay, I'm gonna say, why not? Based on this chart, I would at least expect a recovery move, maybe from $10 to $12. Okay, if I do a quick trade from $10 to $12, $13 and get out, it's possible, right? This could do it. This could do it, but I don't know when or whatever the timing is, because we have a lot of uncertainty into New Year's. This is a losing stock, so if people bought in July 2024, they're underwater right now. They will treat this stock very badly into New Year's, because they'll be like, oh man, I got to sell my shares because I want to get my tax lowered, right? My tax bill lowered. They'll look at this as a loser, especially if it's a short-term capital gains loss. They can use this to offset any gains they made this year. So I'll watch this into December. So any losers like this could be winners next year, just because it's a reflexive action. Animal spirits, reflexivity. That's all you got to know about. All right. Natural Grocers. I think did they have a stock? Man, I know there's a bunch of small grocery. I mean, the problem is like Albertsons is an a-hole. Albertsons and all these guys keep absorbing so many grocery chains. Like all their tickers disappear. Safeway used to have a ticker, right? Albertsons. I mean, I think it was Cerberus Capital or something. They bought them out private and turned them private. And then after that, they sold it off to Albertsons. Now Albertsons and Kroger's, yeah, I think it's KG is the ticker symbol, right? Kroger's has a ticker symbol. So there's not too many grocery stores with ticker symbols anymore. Like they all turn private capital. Kroger's, no, it's not KG. I guess then. Oh man, Kroger's, KR. My bad, KR. Okay, see, not bad, right? But definitely not like Sprouts. Sprouts Growers is like way better than this. That chart is so beautiful. Yeah, I don't think Natural Grocers has one. Let's see. Blah 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 blah. 2001. A new name. Yeah, I don't know if it has one. Yeah, I don't think. Let's see. Natural Grocers. Man, this is weird. So the official name is Natural Grocers by Vitamin Cottage. So NGVC. Okay, let's look at it. Let's look at the. Okay, not bad. So $8 from 2023 at the stock market bottom. It's following the stock market quite well. All right. So NGVC. Okay, I'll keep this in mind. I like how it's looking here. Let's see that. You make a long base. Now you're making new highs since 2014. Okay, not bad. I like the way it's moving. So far, it has a big. It has earnings still to go. So next week. So look at Natural Grocers by Vitamin College. Thursday, 2020, November 21. It's already moved quite a lot this week, 22%. Okay, I'll watch it. Definitely watch it. Something's gonna happen. Large superfoods. I mean, not a brand. It's a brand, not a grocery. Oh, okay. I'll have to look that up too. Okay, yep. Look that up too. I'll look that up too. Yes. Okay, yeah. But yeah, I like Sprouts. That chart is good. Okay, guys. I'll keep these in mind. Okay, LSF. Okay, I'll keep this in mind. Definitely go look through them. So yeah, we should get a mail-in email just to have tickers flow in just for stock-related questions. So once we get that set up, when Portia has time, that'll be better, because I can look up anything, stocks, crypto, any kind of ticker stuff that you want me to look at. I'll just look quickly and give you my opinion just based on looking at a chart. Go like, okay, what do I think? Just looking at a chart, what do I think? That's it. Very, very fast. I can just go through a whole bunch of them. That's the beauty of looking at charts. nobody has time to do anything else, but they can definitely look at a picture. And once you get the patterns going in your brain, you're like, boom, 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 boom. Good. So let's see. I had something for Affirm. Okay, Affirm, the buy now, pay later company. So yeah, it has this kind of beautiful looking shape, but I gotta see what the media said about it. Let's see what the media says about it.
I disagree. I don't think we're seeing deterioration of credit quality at all. If anything, we are seeing extreme stability of credit quality in our portfolio. The fluctuations in delinquencies are seasonal. They always are. Perhaps that is what you're referencing. But just to reiterate, our credit quality is a setting. Our loans are very, very short term. The weighted average is something like 4 or 5 months. We decide what it is that we're going to risk every quarter. And by halfway point of the quarter, half the volume has already been paid off. And so our risk is inherently controlled by the settings that we make in credit. The volume we're seeing and the revenue growth we just posted speak for themselves. We're doing really, really well. Very excited about the holiday season, obviously, but the credit quality is exactly in the kind of control that we want it to be.
That's fascinating. And as we see inflation come down, I guess, and we saw consumer confidence very strong today. That's all good news for you. I wonder about your stable of merchants. And specifically, Max, I'm wondering not just who and how quickly it's growing, but how does a merchant come to a decision, we're going to work with Affirm, we're going to establish buy now, pay later, and it's better for our business? What kind of arguments do you think they go through?
So, this is kind of the pivotal moment. Until about even maybe 2 quarters ago, we would come into a merchant conversation, small or large, and say, hey, buy now, pay later is a thing. Look at us. It's 6-7% of e-commerce. You're missing out. You got to turn on Affirm. There are all these people. It has flipped. We're just 500,000 active in the last 12 months, shy of 20 million active consumers. The conversation isn't about should we use this or not. We're sort of past the point of niche, interesting thing that some kids are using these days. It is a massive trend, buy now, pay later writ large, and Affirm within it is the largest. We're half the revenue of the whole industry. It is now a conversation of, can we implement this before the holiday season, or do we have to wait until January? The demand from the merchant side of the house is really, really strong right now, especially as we head into the holidays.
Is there kind of an indirect way to use Affirm with merchants that don't necessarily work directly with you? I mean, can I go around and through Apple Pay, for example, or through Amazon Pay?
Thank you for teeing that up. I should have mentioned that we are integrated in your favorite digital wallet, whatever it is. We have a massive digital wallet strategy that is just really beginning to roll out. Obviously, you mentioned a few names. We are in all of those. We're in Shop Pay also. We are in Amazon Pay. We are in Google Pay. There's a million places, and half dozen places you can find us. And it's also no secret that our probably my favorite product anyway is the Affirm card. That is something we launched at scale about a year ago. We just posted just shy of 1.5 million active consumers. Those are the strongest, most committed consumers we have in our portfolio. They use the card all the time. They're basically shifting it to be their top of wallet product. So very excited about that. But Affirm is available to you both at the point of sale and in our app.
You know, the interesting thing about the Apple Pay deal, we spoke just months ago when you really had it start taking off. What is the uptick there? How are you seeing the platform being used on third parties?
So we spoke months ago about the impending launch, but it's only been around for a couple of weeks. So it's a little too early to report progress there. We're very excited about not just Apple Pay, but our entire wallet strategy. It has worked really well for us so far, and obviously this particular one is one of the most popular.
On the credit cards in particular, it's interesting because when you think about the buy now, but you and I have talked about this so much, where does the credit card industry fall in relation to where you are playing, right? Where does the discrepancy happen? And with the Affirm card as well, how are you competing at perhaps a whole new scale?
That's exactly right. We are going offline with the card. That's the single most important thing about what we did with the Affirm card. It's a great alternative to credit cards. It works online, works offline exactly the same way. You program in the app whether you want the next transaction to be a loan or a pay now. You can also decide afterwards if you wanted to turn it into a loan. It's very versatile, and half the volume of our Affirm card consumers is offline, and it's growing very rapidly. Last quarter, this number was 45%. The quarter before, it was just north of 40. So people are learning that Affirm can be helpful to them where they go shopping, be it for a party, cart full of groceries, or for a big screen TV, or online. And so we are replacing credit card volume. Fortunately, there is a plus or minus $1 trillion of e-commerce alone and a few $1 trillion of non-e-commerce transactions. Most of that is on credit cards and debit cards, and that's what we're eating into.
Max, we had a Fed meeting that was pretty uneventful yesterday, with the exception of some talk about whether or not Trump could fire Powell. That has nothing to do with your business, but they did say that the employment picture is starting to ease up a bit. And I wonder if you noticed that in your business as well.
As I mentioned, we are feeling very good about our credit performance, credit outcomes. The most important metric I track in terms of macroeconomic state of affairs in this country is employment. So any good employment news is great news for us. We have not seen deterioration in our book. And so from my point of view, it's always been good news. It's been very steady news, which is the best kind. But anything Federal Reserve has to say about the stability and improvement in the job market is just going to accrete to our bottom line, which we will happily reinvest to approve more folks, to drive more exciting deals, et cetera. So from my point of view, the Fed news were great news yesterday.
That's a good freeze frame. All right. So enough. So you got some idea from the money changers how things are going. All right. If you know what the money changing is, if you know what that reference is, there we go. Got some new. Okay, Ollie's bought 7 Big Lot stores. Yeah, somebody's going to convert all that real estate into something else, right? Real estate is still real estate. You liquidate real estate, you get something at least back to pay the creditors. Bankruptcy sales are always the best. You can find good stuff. Man, you can get like nice office chairs, like LCD monitors and TVs. Nice things from a liquidation sale, right? There you go. So, okay, let's go to silver. Let's talk about silver right now. So we're going to talk a little bit about silver. Let's see. I haven't watched this myself, so hopefully it's very interesting. I'm very curious what this dude has to say about silver. Let's see. Blah, blah, blah. Did I download it? Dang, maybe I didn't download it. Oh, too bad. Okay, hold on. So while I download it, you can watch this one from the Bond King, okay? Jeffrey Gunlock. Jeffrey Gunlock is the Bond King. Let's see what he says about the Fed.
Let's bring in now Double Line Capital CEO and CIO Jeffrey Gunlock. Jeffrey, welcome back for our traditional visit.
Hey, Judge. Good to be here again.
It's good to have you. So what is your reaction to what the Fed chair had to say today? He used a couple of R words, the one we talked about last time, recalibration, and then remarkable, he said, when describing the resiliency of this economy.
Yeah, recalibration showed up again, and that's a repeat of the last meeting's sort of word of the meeting. And I think Powell feels very much that he's in a good place now, because since the July 31st meeting, we have the 2-year Treasury rate is up by almost 60 basis points, and the Fed funds rate is now down by 75 basis points. So he's gotten much more in sync with the bond market by a movement of Fed funds relative to 2 years of 135 basis points of convergence in just basically 2 meetings. So I really think that we probably have one more rate cut coming in December, because that would true up the Fed funds rate with exactly where the 2-year Treasury rate is right now. So it is interesting that we've had such a strong performance of the stock market since the last Fed meeting, while we've had interest rates rising. So you've had a tremendous outperformance of stocks versus at least Treasury bonds since the last Fed meeting, and I attribute that basically to the election result. So we had an incredibly consequential election result, very different than a lot of people probably were forecasting as a base case a few months back. And we've had one of the least consequential Fed meetings today, with basically a repetition of this idea that the goals are normalizing, the labor market's normalizing, the quits rate and the job openings rates are kind of where they were pre-pandemic. And so I think the Fed is feeling very much that they are plodding along towards their goals, and he said so in fairly direct language today. So yeah, the thing that's sort of surprising me a little bit is that people are so willing to dismiss the softening jobs market. I mean, the 12,000 jobs, I know people want to attribute that to one-off hurricanes and strikes and stuff like that. But I keep looking at the household survey, and the household survey over the last 11 months has been a loss of jobs of over 300,000 jobs cumulatively over the last 11 months. And so that typically is a little bit more real time at economic turning points. It's still not terrible, the household survey. It's very volatile, so we have to watch out for that. But it is not showing tremendous signs of strength. And the real problem that the bond market seems to be having, from my perspective, and it's being talked about much more in the open, it came up several times at the press conference today, is that the supply of Treasury bonds is getting to be rather astonishing. We have a $2 trillion deficit. It's about 6% of GDP over the last 12 months, and we still have a growing economy. And the interest expense on the debt, which I always talk about, 3 years ago was $300 billion per year. It's now $1.3 trillion per year. And we have a great volume of bonds that are rolling off with very low interest rates from 5 years ago, or even 3 years ago, that are being refinanced at substantially higher rate levels. And this is going to continue to be a supply problem for the bond market. And for this reason, we are not positive on long-term Treasury bonds, in spite of the fact that the economy is sort of gradually slowing down. It's just the supply of bonds is very troubling. And so we recommend investors stay at the intermediate part of the Treasury bond market and not out in the 20 and 30-year bond sector. In fact, when we were at the low in rates, basically several weeks ago, we made another duration cut or maturity cut in many of our bond funds because we do not want to be exposed to this fiscal financing problem, which I think could very well lead to rising interest rates in spite of the fact that we might have a slowing economy. So interest rates are rising. We have the curve is not inverted anymore, 2s to 10s. It's not very positively sloped. It's a very flat yield curve. And we're anticipating that the Fed will cut rates again in December. So not a lot to take away from today's meeting. It was pretty much a repeat of the comments that were made by Jay Powell at the last meeting. But I do think that he is much more in line with the bond market, and he is correct in exuding the idea that he's in a normalized sort of a place and that he's making progress towards the mandate. The inflation numbers are lower, of course. The PCE core is at 2.7. There are some inflation numbers in the low 2s. We believe that if we keep the price of oil around the low 70s, which has been a lot of resistance down at around 70, we think we're going to see potentially a headline CPI that's below 2% in about 4 or 5 months, based upon the structure that's there. So Jay Powell will be able to pretty much declare a victory. I also commend Jay Powell for bringing up the lags on the rent rolls. The part of the inflation rate that remains elevated is kind of rent rolls. The new rents have almost no inflation, but the old ones, they come down with a lag. And so that part of the inflation picture is probably still going to provide something of a ceiling on where the inflation rate is going to be for 2025. I don't think under the base case we'll see a 3-handle CPI inflation rate during the next 12 months.
I mean, Jeffrey, we talked about the backup in yields. You certainly did. I mean, what role do you think that might play, if any, in where policy does go from here? Powell said, quote, "We're watching that. We'll see where they'll settle. Right now, it's not a major factor in how we're thinking about things. Do you think it needs to be a bigger factor?
Well, I think that one thing with the Trump election and the Senate going to the Republicans and perhaps the House, if the House goes to the Republicans, there's going to be a lot of debt. There's going to be higher interest rates at the long end. And it'll be interesting to see how the Fed reacts to that, because Trump says he's going to cut taxes. At least he said so in the campaign. And he's very, pro-cyclical stimulus. As basically, it's in his DNA. So it looks to me that there will be some pressure on interest rates, and particularly at the long end. So I think that this election result is very, very consequential. And I think most people were surprised at how widespread the strength was for the Republicans. And maybe it was just a denunciation of all the lawfare. I think that was a really big issue in the election. People, all these crazy lawsuits being filed almost on the same day back a year ago. And people just don't like that. People don't want this kind of strange manipulation. And I think that Trump's authenticity is something that attracts people. Unfortunately, he's very outspoken about the types of policies that are very stimulative that he wants to put in. And he's always been a debt guy. So I'm really worried about that. I'm glad that Elon is somewhat associated with this administration. I mean, they're talking about looking for some spending cuts. That'll be really interesting. I mean, Elon, if you're listening, give me a call. I can help you try to find $1 trillion or $2 trillion out of spending cuts, because we certainly need that. But I think that we have a risk here of there being a backlash from the bond market. And the stock market has done so well since over the past couple of months, and the bond market has not done very well at all. And it's starting to be kind of an interesting valuation issue. I think Goldman Sachs, put out a paper talking about forward returns and how bonds are very, very competitive given the yield to where they are today, where you can get 7% yields out of not terribly risky, say, double B type of a corporate portfolio. And I think it's quite likely that bonds will be much more competitive going forward than they were. But in particular, what's interesting is that the spreads on corporate bonds are very, very small in terms of the incremental yield versus treasuries relative to history. They're almost where they were really at the lowest. For like junk bonds, it's only about 270 basis points higher than treasuries. Investment grade corporates are inside of 80 basis points over treasuries. But I don't think that that means you should be avoiding corporate bonds. I never liked the really low rated stuff, the triple C's and all that. But in single B, double B, weak triple Bs, I really think that there's a reason why spreads are so tight. And it's because I think the corporate bond market is less risky on a relative basis than the treasury market. It almost reminds me of where it was back at the beginning of my career when Reagan came in and people were worried about the deficit, and you had the higher quality bonds like IBM, for example, I remember at the time, actually yielded less than treasuries because people thought IBM was safer as a borrower than the treasury market. And I think that's one of the things that's propelling this corporate bond performance that's been very, very strong. The reward isn't very high, but the risk isn't very high. These corporate treasurers are smart. And when rates were so low, I mean, when 3 years ago, the high yield bond market, believe it or not, yielded 3.5%. And so these treasurers locked in these very low rates, and there isn't a maturity wall coming for the next few years. And so it'll be interesting to see how the spread markets change. And we've already seen pretty much spreads tightening across the board on non-treasuries. It's the treasury market that's been the underperformer in recent months, and I have a feeling that could continue.
So you told me prior, and I think you alluded to it here when talking about the tax cuts, you told me you were not in favor of re-upping the Trump tax cuts. So he obviously thinks he has a mandate. He may, in fact, have a wide enough margin in the House by the time this is all said and done to do that. Do you stand by that view that they shouldn't do that? And I also want to know what you think about that Larry Fink op-ed in the Journal the other day regarding the deficit, which you are obviously concerned about. that essentially you can grow your way out of this deficit problem. You just have to have a higher nominal GDP growth, in fact, to do it.
Yeah, I actually agree with that point, except there's a caveat, and that is we have to stop this deficit spending. Jay Powell said this in the press conference, to his credit. He said, we can't keep spending $2 trillion more than we're taking in. The math just doesn't work. Ben Franklin said one of the great natural wonders of the world is compound interest. But when you're compounding your debts, you're running into a real, a parabolic compound interest curve that's working against you. So we really need to have less of a deficit, and I don't think that's going to happen in the quarters ahead, based upon the strength of Trump in this pretty resounding victory. I think Harris actually underperformed Biden in just about every county in America. It's kind of hard to believe it could be that widespread, but the lack of authenticity from Harris was really kind of fatal. And of course, she had an albatross around her neck with a approval rating of her boss that was just mired at 40 or lower for the last few years. So she really had an uphill battle that she was forced to climb. But I think that we're not going to get better news on the deficit in the first couple of quarters, maybe first year of the Trump presidency. I really do not want tax cuts, frankly, for anywhere in the economy, because I don't think that we can continue on this path. And if we re-up the tax cuts, that just means that we're extending the timeline on this deficit problem. I'm actually writing, it'll be out in the public in about a week or two. I'm writing my own white paper about the debt crisis is starting to come much more in focus. And I run through some basic arithmetic on that, and it's really rather sobering. So I do not like long-term Treasury bonds. The last thing I did relative to long-term Treasury bonds was to sell them.
You had been calling for a recession at some point. Do you still think?
All right. Very sobering. I can't wait to read this paper that he's going to write. Selling all the Treasury bonds. Isn't that what I mentioned maybe 3 weeks ago about gold over Treasuries? I think gold, silver, palladium, platinum, man, this stuff, we are entering a new regime. If that's true, and Treasury bonds can't even compete with corporate bonds even, wow, you trust a corporation more than the government to repay the debt? Woo, that's a game changer. So anybody out there, I keep seeing these memes about like corporate feudalism and things like that. Hey, you could be in a world where you are under the thumb of Facebook, Google, Amazon, Apple. Like that's your new country. So don't believe in a country made from the people, right, to the government. It's actually corporatism. It's what Be Brave is always harping about. This could be interesting. If government does not secure faith, in its bonds, what is the new government, right? What is the new government? Yeah, the technocracy. Fascinating. I like this. I love this. I love these type of big macro picture type ideals. I'm not a macro guy. I don't like to suck my own cock, all right? Because a lot of macro people, they are just very ego driven. So they love these big ideas because when they're right, they can just go, I told you so, for the next 10 years, 20 years. But I like it. I like the picture that's being painted to me so far. It's something to consider. So when you see gold and silver outperform, you want to do a stream? Oh, the technocracy. Can we do one on the 4B stuff too? The femcells, the technocracy. How I don't know. That's gonna be crazy. That's gonna be crazy stuff. But anyway, let's continue. I like the video so far. I like the video so far.
Possible, likely, or do you think that the election of Donald Trump changes the calculus because he's going to theoretically have a more pro-growth agenda, if you will? You certainly would have. You have a lot of pent-up demand as it relates to M&A and other things. How do you view that now?
Yeah, I think that's right. I think Trump. It's clear by the action of the stock market, not just yesterday and today, but really over the past couple of months, as the support for Trump was on the rise, kind of steadily for the six to 8 weeks prior to the election, we see tremendous outperformance of stocks versus bonds. It's getting rather stretched, but I do think that it's right to see the Trump victory as reducing the odds for near-term recession fairly substantially. And so I don't really like the way it's going to be accomplished, because I think that's going to lead to this problem on long-term bonds. But we'll see what happens. Certainly the odds of recession drop when you have this type of an agenda being promoted in plain English for the past 3 months by Mr. Trump.
Does it change the trajectory of the dollar, which is obviously one of those trades that had been a so-called Trump trade? We saw the dollar index rising, and it seems to be on a higher trajectory from here. Is that what you see?
The dollar seems to be extremely correlated to interest rates. If you take a look at the chart of the DXY index and overlay it on the chart of, say, the 10-year Treasury, it's the same chart. So what happens is our interest rates, have been going up, and that's supportive of the dollar. If I'm right, and there's still some potential for long-term rates to be suffering under deficit fears, then the dollar would probably still go higher. And so for the time being, we've been neutral on the dollar for much of this year, and it's been trading in a range between about 108 on the DXY index and 100, and lo and behold, right at the dead center of that range, very nearly the dead center. And that's the same on the 10-year Treasury yield. It got down to 360. It's been up at around 5% or so, and we're right in the middle of that. So the dollar is extremely influenced by movements in U.S. Treasury rates. And so I believe that is going to continue to be the case, because it's been an extremely strong correlation over the past several quarters, and there's no reason to believe that's going to change.
It seems as though you think that Chair Powell, at this point in the cycle, from when we started doing these interviews a couple of years ago, it feels like at this point, can he, at this point, declare victory? He obviously said today explicitly that he wasn't, and some like Stan Druckenmiller this week suggested that they might try and do that a little too early. But does he have a right at this point to declare victory, given the trajectory of inflation, where the economy is, again, using the word remarkable to describe it? Should he?
I think it's a little early on that, but I think he'll be able to do that come, say, March or April of next year, unless we get some sort of a shock to commodity prices, particularly the price of oil, because we're going to get on the headline CPI. We're quite confident, given the current structure of the commodity complex and where rents are going and the like. We think that the CPI is going to have a one handle on the 12-month headline number come March or April of next year. And if that happens, well, then I think you can start talking about declaring victory at that point in time. I think it's too early now. He's too prudent. He's too careful of a Fed chairman to make that assumption. He says we don't predict, we don't assume. He said those words in the press conference. I applaud him for that. But the trajectory he's on, he's getting closer. When we started these conversations, the Fed was so far behind the curve. They were so loose compared to the obvious trajectory of inflation. And then he was too tight. And now he has gotten himself, begrudgingly perhaps, but he's got himself almost in line with, I've said this almost every conversation, Scott, the Fed follows the 2-year. And I know people push back against me, but I can prove it mathematically, and it absolutely follows the 2-year, and he's almost exactly in line with it. So Powell is in the right spot where he is. He says the labor market's normalized. I agree with that. The inflation rate has been coming down. I think he deserves credit for what he's done once he finally started cutting, and now he's cut 75 with the 2-year going up. He's right to be in a relaxed frame of mind. and his mood and demeanor in the press conference were very good. I thought his answer to, are you going to be demoted or would you step down if Trump asked you to? I thought that was a great answer. Just no hand waving, just no. He's not stepping down. I think that's good.
Yeah, I think that's why we played it. It had a bit of I don't know drama necessarily to it, but the way that the chair answered that. I mean, how do you view that? I don't know if it's a wild card or not. That Powell obviously thinks he has some room ahead to continue to cut rates, right? He made that clear. He thinks they're too restrictive. To the degree of which they are, that's still unknown. But he also is potentially going to be dealing with reflationary policies from a new president at a time where the economic backdrop, Jeffrey, is pretty good. It just creates tension, I think, in the relationship, if you will, moving forward.
Yeah, I think that's right. I mean, I think there is a risk of a reflationary policy. We don't know what the tariffs are going to look like. They could be, surgically applied, which would be great because that's kind of where it was the last time. Or they could be, just very heavy-handed. That would obviously be potentially inflationary, depending on what method is used on these tariffs. And of course, tax cuts that he's talking about are horrible for the deficit. So we've seen that. And I'll just repeat it one more time. As Trump became more likely to win, we've seen rates go up, and we've seen, in spite of those rising rates, we've seen stocks going up. So it's been a very obvious sort of a Trump trade. I don't know why that one should expect that to change in the near term. I mean, we have to see what happens come January, third week of January. But I'll be monitoring the rhetoric that comes out of Trump very carefully. And he will be probably trying to browbeat Powell into being less restrictive, if possible. So it's going to be an interesting time period here. We've had quite the week. I think Powell looked a little tired. I think a lot of people had a late night on Tuesday. And so this meeting is really very inconsequential. I think what we see December and then the first meeting of 2025 is really going to be very important.
In terms of I guess the drama between President Trump and Chair Powell, we've seen this movie before. We'll see if the sequel is nearly as dramatic. It'll be fun to watch. Let me ask you this: of the Trump trades, if you will, the one that we saw to the downside was China. You've told me for many months that you liked India. Do you like it more today because you anticipate higher tariffs on China? How do you view that whole paradigm?
Well, I like India a lot for the long term. I mean, it's obvious that they're on the ascent, not just demographically, which is extremely strong demographics, but they're clearly a beneficiary of production shifting away from China, as is Mexico probably. So I think that that's not something that I even think about as a 3-month or 1 month. I'm talking about a multiple year horizon. I just think India is a great place to be for the long term. The dollar is very stable. Oil has been very stable. It's really remarkable how we've seen such volatility in gold and silver being up so much. Now Bitcoin is on a moonshot.
I was going to ask you that.
This is all. I think. Yeah, I think this is all about.
Did you go out and buy some Bitcoin on Tuesday night?
No. I have no interest in cryptocurrencies, but I do think that it's interesting that gold has been rising and silver has been rising relentlessly pretty much all year. And I think that's an anti-deficit, anti-central bank type of a mood that's going on. Central banks are buying gold like crazy. Retail buying, even Costco is selling gold, and they can't keep it in stock. I think people are viewing Bitcoin and gold as not speculations as much as they were 5 years ago, but more as permanent portfolio allocations. And I do have gold in my portfolio, so I continue to hold gold. Bitcoin is for I'm a coward. I can't stomach that type of volatility. So that's why I do bonds primarily. Let the momentum guys have their fun, but I'm a value guy primarily. And so I don't have mechanism for valuing fair value on Bitcoin, so I stay away.
All right. We'll leave it there. I think we covered so much. I so much appreciate your time as always. Jeffrey, thank you.
All right. So you heard from the Bond King. You heard from the Bond King. It's very important to listen to him. And he mentioned Mexico, India, as a stopgap against China. Anyway, so let's look at the yield curve right here. I'm looking at 2-year versus 3-month. So this is kind of, actually, it's not really the way Powell looks at it. He'll look using the 2-year and 3-month yield, looking in the future for the 3-month yield. So 3-month yield future market, not actually the three. So yeah, I'm really confused. I can't get that kind of chart. I don't have like the data he has, so I have no idea what the futures market for the 3-month yield looks like, and then have to put it back here. So I'm just looking at simply the 2-year minus the 3-month yield. And based on this curve, just simply using 2-year and 3-month, you can see like the inversions that happen. And I essentially just did an EMA, an 18-month EMA. So this cyanish turquoise kind of line, this turquoise, I think is more turquoise line here, shows you when it inverts, it drops below 0%, goes negative, and then disinverts. So it inverts and disinverts. So when that happens, usually there will be a crash. That's what they would say. There's a crash. So this happened during the Great Financial Crisis. Again, in COVID, you see this briefly. So somehow this curve predicted COVID. Don't ask me why. And now we're here. We've been bouncing up and down, but we haven't crossed over the 0% line. We've already inverted since December 2022. That's when a lot of people were like, oh man, the crash is coming. The crash is coming. Sorry, folks. The crash does not come until this thing reinverts, okay? Or, I mean, disinverts. I guess it's disinverts. I use the right terminology here. It inverts and it disinverts, okay? So if it doesn't disinvert yet, we can't call it a crash. Once it disinverts, it takes about, let's say, 100 days after the disinversion to 200 days before the start. So let's give it more time, right? So we don't know when it's going to happen. I don't know when it's going to cross over the 0 line. So maybe I'll say it happens here. Let's say it crosses over 1 year after, around August or something. I don't know. I just arbitrarily picked it. So then let's say the crash will happen around March 2026. That's a pretty good timing, before tax day, March, spring. We usually, back in the old days, the New Year's happened in March of 25th. Okay, that's how the Anglosphere usually did its New Year's. So we could say it happens around March 2026, maybe. So we'll wait for that. That's one signal to look for. And I'll talk about, I was going to play this video maybe a couple streams ago, but we didn't have enough time. We'll try to do it on this. Maybe another stream about the Hindenburg omen. The Hindenburg omen, yeah. So that's what it's going to be about. So let me play this stuff about silver. Silver. And I'll play this for a while. Yeah, I downloaded it, right? Yeah, I downloaded it. Okay. So you can watch this. We'll see how silver does, because silver was mentioned in the other stream. I mean, the other video. Then you guys can see how silver does. I haven't watched this myself, so I'll let it play. Okay, guys. Oh, and I have the super micro one too. Maybe I'll play that at the end. Oh, hold on. Yeah, I forgot. I was going to answer this. Chris Reed asked about the unions and stuff. I can't tell you too much. I mean, that's too political. I mean, unions and labor is really a political, societal issue. All I can tell you is that like labor is getting stronger in their bargaining power. So that's why when I told you about Russell, let me give you the link to his blog. He believes in gold over treasuries. Okay. And you saw Gunlock talk earlier about treasuries, and he doesn't like them. The long bond, like treasuries, meaning the treasury bond, 30 years, like long bonds. And you can go to this dude's blog. You have to subscribe though for all access, but it's okay. You can read some of the free ones and you get an idea of what he's talking about. His thesis is that gold will outperform treasuries over the long term, and the reason why is that labor is becoming more expensive. So unions, yes, it's a big, and the thing is, like, okay, we can affect things in America in some extent, but it's really a state to state issue, right? A lot of blue states will be pro-union, and they'll stay that way for quite a long while. And the other thing too is that when you look at the EU, yeah, very socialist. So that's going to be a higher price for labor. So I don't know how China and India, Mexico, and the other BRICS countries, they'll try to do this. I'm guessing they'll try to build their middle class. We can't do the deflationary cheap labor type of tactic as we could for a long time. A lot of people will start getting a little uppity, right? The slaves are getting a little uppity, the hoi polloi. So I don't think that labor costs will keep decreasing, and unions are one part of it. It might just be an American phenomenon. Europe will have the government on labor's side anyway. I don't think they really need unions there. We'll have to look at Mexico, India, and China and how they do. I think China, yeah, the Communist Party, they can, if anybody gets too uppity there, right? I think China will do a better job at controlling costs, but they're already seeing a lot of offshoring to Vietnam, Cambodia, Laos. So even China has their own version of Mexico, right? Just like we have Mexico. So that's something to look for. And you have to look at it in an international sense. So if anything about unions, it will just affect state to state. And then from there, it will affect from how we are positioned versus Mexico, Canada. And I'm not sure how Canada is right now, but Canada's labor and taxation definitely affects how their economy has been going, their tech sector. That's all I got to say about that. Because when I was working, a lot of the tech people, they migrated from Canada. They wanted the better pay. Even they lost, you try to double dip. Maybe they still got their health insurance. I'm not sure if the Canadians still got their health insurance while they were working in the US. But yes, a lot of Canadians wanted to work in tech in Silicon Valley. They got higher pay, and they got lower taxes compared to, even if they worked in California, Californian taxes, income taxes, and all that was still better off than working in Canada. So there you go.
Okay, everybody, we're going to take a close look at silver and what exactly is happening with the white metal We're going to do what I call, or what we call, a forest to tree approach. What that really means is looking at the big picture first for the background in what is happening for silver generally. And then we're looking at so that's the forest, if you like. And then we're going to zoom in and look at the trees, which basically means looking at the detail of what is happening on a much sort of smaller scale, much smaller time scales. So the big picture for silver really is dominated by the same thing as gold, and that is whether or not we're in a precious metals bull era. Now we know we're in a gold and silver bull market because the charts have broken out above key points and they're above rising trend lines, rising moving averages and all that sort of thing. So we know that they're in a defined bull market, but are they in a bull era? And this chart here, the gold to SPX ratio, tells you whether or not we're in a precious metals bull era. You can go back to the 1930s here. Gold was actually pegged. The US dollar value of gold was pegged. And we broke out on this gold to SPX ratio, and it kind of broke the peg actually, and gold had to be revalued, so that the peg was adjusted. So that was the 1930s. It's a little bit harder back then to see clearly what's going on because gold wasn't exposed to free market forces. But it certainly was in the 1970s, and we had the same pattern again. The gold to SPX ratio broke out. It was less of a V-shape breakout and more of a gentle arc-based breakout, a little bit like the one that we're seeing at the moment. But there's a breakout there, and the 0.5 level started to identify itself as a key sort of resistance level at that point, and it did so again back in the early 2000s. I mean, what happens when this chart rises is that gold is outperforming the S&P, so that's a precious metals bull era, because the S&P under normal circumstances would massively outperform gold. So you can see here from 1980 to the year 2000, for 20 years, the S&P massively outperformed gold. The chart was dropping, so the S&P was outperforming gold. Now, if we, and I'm just going to put on the 28 period moving average there so that you can see it as well, because the label is there. If we look at what's happening today, we see this 0.5 level again is a support and resistance level. It proved pretty important back there in the previous bull breakout in 2008. It got above that 0.5 level. Now we've not fallen much below it. We haven't come all the way back down to previous lows on this ratio, and we're already forming a basing pattern to break out from. This kind of lines up with a number of other charts that suggest that in many ways the period from sort of 2011, 2012 through to about 2015, 16 was just a sort of a pause in the ongoing precious metals bull market, and we've been gradually building a breakout since then. Certainly, as far as this ratio is concerned, we've been going sideways for at least half a dozen years, which means gold has been keeping up with the S&P. The S&P hasn't been able to outperform gold. So this is the first prerequisite of a precious metals bull era, but we haven't got the final piece of evidence yet. We haven't broken out above 0.5. We haven't got above that clear support and resistance level. So it's a bit difficult to say we're in a precious metals bull era based on this chart. And in fact, it's probably the last chart to confirm that we are in a bull era, because there are many other ratio charts like gold versus money supply, gold versus DXY, gold versus sort of CPI, PPI, inflation. All of those sorts of charts are showing that gold is breaking out into a new bull era. So this is versus the S&P. So it's interesting, isn't it? A lot of people have said that if you strip out the top few names in the S&P, then gold would be breaking out versus the SPX. One way of visualizing that actually is that there's a chart that we can get on TradingView, and it's the equal weighted S&P. So it kind of weights all the stocks in the S&P equally. It doesn't, for example, Nvidia, which has a very disproportionate place in the S&P 500.
So, you know, I I probably should caveat this. He mentioned the equal weight. I haven't gone over this in my lessons. I will have to at one point. So you have to understand SPY is cap weighted, right? That means all the 500 stocks in that index is weighted by the market capitalization. They're not weighted equally. Okay, so I'm going to have to go over this in a lesson at one point. I think that's very important, what he said right there. That's a distinction that you probably should know. And when he's using the ratio charts, he's using the SPX over the gold or gold over XPX, something like that. You can do it differently where you use the equal weighted. So I think we're going to have to reserve one big lesson talking over all the little ratios you can do, talk over the equal weight, things like that. Yeah, that will be very helpful for some of you guys. Okay, continue on.
It doesn't give that the large weighting that it actually has. So the fact that it's over 3 trillion market cap is kind of balanced out because it's given an equal weighting to the smaller companies. So we can sort of level the playing field by using that chart. And if we do that ratio versus gold, so this is the SPX equal weighted, SPXEW versus gold, what we can see is a more clear sort of rotation taking place. So when this chart's rising, the S&P equal weighted is outperforming gold, and when it's dropping, the S&P equal weighted is underperforming gold. In other words, gold is in a bull market. So for a precious metals bull era, we need this chart to be rotating and moving downwards. The upwards trajectory, the upwards momentum needs to decline, and we need to start to roll over. Well, we've been doing that, and a number of support lines have actually been broken already, rising trend lines. And another one that we're resting on right at the moment is probably the last rising trend line just about that you can draw in this chart. I suppose you could start drawing ones like that, but we're already broken below that actually. If you start using this point here or that point there as a starting point, then these trend lines have already been broken. So it's probably just about the last rising trend line that you could reasonably put on that chart. There's a horizontal support and resistance zone just below where we are at the moment. But regardless, this chart does appear to be rotating in favor of gold, and we've already moved from a low in 2018. I don't think it was $1,200, was it? Was it that low? Perhaps it was. Let me just put the gold chart on top. Bear with me a moment. Let me add the gold chart, and we'll see where the gold price was at that point. So here and here. So yes, it was $1,200 gold. Of course, we had the low back here, which was 1,050. But when we hit the top of the inverted arc or dome there, it was 1,200. So that's correct. That's good. I just wanted to double check that was not misleading. So we've moved from $1,200 gold in 2018 to $2,500 gold now. So gold has doubled as this rotation is taking place. So that's your forest to tree. Well, that's your part of your forest to tree approach. We've looked at the forest. We've looked at the evidence that we are gradually entering a precious metals bull era. Oh, and by the way, should we get down to the bottom of this dome, then my target at the moment, as it stands anyway, is anywhere from about 8,000 to 12,000 gold. I think that's a reasonable sort of expectation. Gold tends to double, then double again, then double again, and then sort of rise a little bit more. So you can see at least two or three doublings of the price of gold. Okay, so that's as I say, the big picture. Now zooming in a little bit, or a little bit more detail here, the gold to silver ratio. In a healthy bull market move, you often see silver outperforming gold. It's not always the case. So this is just one piece of evidence that you'll be able to point to cases where in a precious metals bull era, gold is outperforming silver. So that certainly does happen. But as a trend overall, or at least at this stage in the process, you would want to see silver outperforming gold, because silver, of course, is lagging a long way behind gold. So it'd be encouraging to see silver. I don't want to use the word playing catch up because that's a little bit misleading. We shouldn't always expect instruments to catch up just because a gap has opened up in their performance. We can't assume that they are ever going to catch up again. Gold may, over time, always outperform silver. So that is not something we should assume. But in any case, this is part of the evidence. And I've labeled this sort of the good area and the bad area. It's just that if gold starts to strongly outperform silver, then it's not usually a particularly good sign for the precious metals as a whole. Silver outperforming gold in a strong bullish move is more favorable. So we are just about in this good zone at the moment, and over time I'd like to see silver continue to outperform gold. So I'd like to see this chart continue to move to the downside. Now, looking at silver itself, and this is again is using the forest to tree approach. So we're looking at the big picture first, and this goes all the way back to the 1970s. I've labeled the bull market for silver, bear market, the basing period, next bull market, which broke out here and rose all the way up to the top here. So that was a bull market, and then we had a bearish phase. Now, I'm not going to say it's a bear market because it's a bearish phase that you could view as being in an ongoing bull market. We didn't come all the way back down. It's formed a base at a higher level, and we are now breaking out. So I want to zoom in a little bit here and just look at this period from, let's say, 2010 till now. The $28 level is important. It was significant support during this period, sort of between 2011 and 2013. It kept testing that $28 level, and when it eventually broke below it, then we came all the way down to somewhere around $12 or a little bit less. And then on the way back up, the 28 level was important again on this monthly chart. These candles are monthly candles, so the price is oscillating up and down within these candles during the month, and then at the end of the month, the candle is fixed, and we move on to the next candle. Green candles if we close the month higher than we opened, and red candles if we close the month lower than we opened. And you can flick between candle charts and line charts. So if you want to make it simple and just plot the line that joins each monthly close, then you can hit the symbol for the line chart, and you can, it just kind of clarifies it and makes it simple. It gets rid of the candles, and it's a simple line chart. And on the line chart, you can see that $28 level is very important. So, okay, so we know 28 is important. Now let's zoom in a bit and look at the weekly and look at the period from 2020 to now. So we're getting down towards the out of the forest and into the trees. So 28 is that level that we want to bear in mind. Okay, so what I'm going to say at this point is, as long as we are on a monthly closing basis above 28, then the bull trend is intact. But you have to wait until the end of each month to get that confirmation. Now, on a weekly basis, the 28 level is also important. It's not quite so clear cut because we have a couple of candles here and there that slightly violate that 28 level. So you could say it's 28 to 28.64, 28.65. So there's a zone of support in there on the weekly candle chart. And we're starting to see on this weekly candle chart evidence of an expanding descending wedge. Okay, so you've got the support line, you've got the resistance line. Excuse me. So now what we want to do is take a look at it on the daily basis, so the daily candle chart. And then we have the daily candle chart, and that expanding wedge is much, much clearer on the daily candle chart. We can see very clear support in there, and we can see very clear resistance tied into those upper and lower thick black lines that I've got on the chart. You can also see these rising support lines. There's one on the previous upside move, and there's one on the current upside move. Okay, so you've got two rising trend lines. Now notice on the latest one that we've just sort of dipped down below that rising trend line, and we've broken it, and we still haven't actually hit the upper resistance line. Now the upper resistance line is going to be about $30.45, $30.50, that kind of level. So what can we conclude? Well, any move above $30.50 would be very bullish indeed, because that would be a breakout from that expanding wedge. So that's the first thing to say. So a daily close above, let's say $30.50 50 cents would send a strong bullish signal that the next up leg is coming. So so what I've said now is that any move below 28, and we probably should be just stepping aside for however long it takes, because 28 is an important support level, and there's no point hanging around in silver if it breaks down below 28. Okay, that's the first thing. The next thing is if we break above 30.5, where's it going? So you notice I've got some lines on the chart there, a red line, a green line, and a black line. Now, if I just press a couple of buttons here on the keyboard, those are distance, well, they're moving averages. So the red line is the 12-period moving average, the 12-day moving average. The green line is the 36-day moving average. And the black line is the 150-day moving average. You can pick more or less any numbers you want. I could have put 10, 50, and 200. You know, you're going to get the same analysis out of this. So the point is to pick a short, a more medium, and a longer term figure. Okay, and then what you get if you plot the distance from moving average, it's plotting how far away you are from each of these lines. So you can see the price is very close to the red line. So in terms of the distance from the 12-day moving average, we're almost at zero, because price is almost on that red line. It's almost on the 12-day moving average. It's also quite close to the green line. So you can see the green distance from moving average being plotted here. We're only 2.5% above the 36-period moving average, the green line up here. But we're quite a long way above the black line, and the black line is the 150-day moving average. And you can see that we're currently 7.5% above the 150-day moving average. Okay, well, that's all very fascinating, but how does that help us? Well, it helps us in estimating where price might be going, because if we look, for example, at the more medium term moving average here, you can see that generally speaking, apart from occasional spikes, which we can't sort of expect, they just come along unexpectedly, sort of thing. But more generally, we top out at about 12 to 14% above the moving average. You can see all these multiple occasions where we get to 12 to 14% above the moving average, and then price retreats. So where is 12 to 14% above the 36-period moving average? Well, I've of course calculated that for you. So the 36-period moving average is the green line, and if price begins to break to the upside, the green line might rise at this sort of angle. I'm just borrowing the angle from the previous leg up. So if it turns around, it could move up at that angle, which means that, let me just draw a dotted line to show you what might happen. So your 36-period moving average could do, and emphasis on the word could, do that sort of thing. Like that. And take that line away now. Okay, so if we were to start moving up pretty rapidly, we can guesstimate the sort of angle of ascent. It might be something like that. So it could be something like that, for example, if we were to start moving up fairly rapidly now. So in terms of time, when we get to our target, it could be sometime towards the end of September. And in terms of target, well, 14% above that moving average is going to be somewhere around $34, isn't it? 12% above the moving average would be, of course, lower, and that would be around $33.50. So let's say $33 to $34, could spike higher to 35 or higher if we get one of those spikes. Okay, so that's an estimation of where we might go using that particular moving average. Now, if we use the 150-period moving average, we can see that it usually gets up to around somewhere around 15, 16%, can go up to 30%, and in a very spiky move, it can go up to 65%. So, you know, it can go crazy percentages higher, at least 50, 65%. But if we're not greedy, and if we just say that we're going to get a move up to a regular sort of peak, it would be between 20 and 30% above the 150 moving average. So 20 to 30% above this moving average and let me just move the starting point down to that moving average. 20 to 30%, well, 20% would be $34, 34 and a half, and 30% would be up near 37. So that gives us a slightly higher target range and gives us a little bit more confidence that we could spike a little bit higher into the mid to upper 30s as opposed to the sort of lower to mid 30s around the $34 level, for example. So we're starting to build a target area, a target zone based on different moving averages, and it sort of is in and around this sort of area here, kind of zone, topping out perhaps in the upper 30s, and the lower target zone might be around 33, 34. So that's the sort of target area for silver, as long as we A, stay above $28, and B, get that break above $30.50. Okay, so those are the two numbers to remember. 28, we've got to stay above. 30.5 would signal a high probability of a move towards that those mid 30s. Now we can do some more classical TA on this as well. The breakout from the previous basing period was actually here at about $26. Now we can measure $26 to sort of $32. That was the flagpole. This is a flagpole. That's the flag. And if we place that on top of the breakout level, and breakout level would be $30.50, as I said, then that gives us a target value of $37 as well. So a couple of different methodologies there pointing towards the $37 level. It depends how you measure your flagpole here, but I think that is a reasonable place to measure the flagpole. I mean, we're actually being quite conservative there, because you could argue that a flagpole is that. Let me just make the line a bit bigger for you. You could argue that that's your flagpole, and that's going to go on there, and you're going to end up at $44. So by measuring this as the flagpole here, we're actually being very conservative, and with that estimation of $37. So again, it's going to be a case of watching as this progresses. I suppose as we get into the mid 30s, assuming we get the breakout and we get into the mid 30s, then whether we spike into the mid 40s somewhat depends on unforeseen events and how the market is reacting at the time, and how the price chart looks at that time. I mean, the price chart would look pretty stretched, and the distance from moving average would be getting very stretched, of course. So profit taking area for silver, assuming we do hold above $28, is going to be anywhere upwards from, let's say, 34, shall we? I think 33 might be a bit too conservative. So anywhere from 34 upwards would be your sort of profit taking area, because I suspect once we do hit the peak, this next peak, then the hangover from that could be fairly severe. It wouldn't surprise me if we had a large drop back down into the low to mid 20s, which of course, if we're up somewhere up near the high 30s, would be a bit painful for many. Okay, that's the forest to tree approach for silver. That went on a little bit longer than I anticipated, but I hope you found it useful. And let's just watch those numbers, shall we? $28 on the low side and 30.5 on the high side. That's what we're looking for. Okay, that's it from me for now, and hope you all have a great day. Speak to you all soon. Bye-bye for now.
Alrighty. Okay, guys. So you got those numbers, right? You know what silver is gonna go towards. So I think that's pretty good analysis. Very detailed. Now, let's look at GameStop. I told you guys yesterday I saw hints and clues that the meme stock revolution was going to continue again. We are in our second phase. Come on, how many times have we done this? We've done this so many times already with GameStop, right? Pump and dump, pump and dump. What was the last time right here? Come on. I keep forgetting how long this was. Bro, it was like 2021 was the hot fire going from it had a split, so what was the split again? Reverse split 4-1. Yeah, this used to be like a $20 to $240 stock, right? $400 stock, something like that. Yeah. Anyway, so now we're here. We see the buildup. The spring is winding. We had initial pump in May of 2024. We've retreated. We tried to do it again in the summer, but we couldn't do it. Now I see it again. I see it building. It got above 23. Oh, yeah. And guess what? You have all those people making money on the Donald Trump Truth Social stock. You see that? You got that nice meme move. Yeah, I bet a lot of money here is itching to go to somewhere else. It wasn't AMC. AMC had earnings. That was a dud. Someone tried to pump it, though, before the market closed, before earnings. Someone did try to pump it. They tried to push it up to $5 from $4. They were trying. Somebody was, but it didn't happen, But hey, we got GameStop at least. We still got GameStop. And I forgot what the other ones were. I'm going to have to look it up. But this earnings looks like it's going to be Wednesday, December 4th earnings. So we got some time. So if you guys got it below 23, good on you. Keep holding. Once we break 27, that's the area I'm looking for, 27 to 28. That's when this excitement starts again. So get your cash ready. And we were talking about small caps, right? Well, the most aggressive of the small caps with the M&A, the mergers and acquisitions, is XBI. You see now it's broken out of that rectangle set in February. We still have room to go. So once I see all the stuff aligned, I see the liquidity coming back into the market in such an aggressive manner. You saw the regional banks, you saw all that stuff. This is where the fun starts. The bubble starts, and you just start throwing your cash in any kind of pot just to collect the money. It's like getting rainwater. The storm's coming. So get the rainwater. Anyway, I'm going to go back to this article because I was talking about AI and accounting and Martin Shkreli. Guess what? AI can do accounting better than anyone. So how can you get an edge by just reading 10K forms? You probably can't. The big boys already got AI doing it for them.
Are up 12% today, but still struggling to bounce back from a series of accounting issues. The company giving disappointed, unaudited financials this week after its accounting firm resigned. One AI platform has been sniffing out suspicious transactions at the companies for years. Chris Bonatti is CEO of Hudson Labs. Her firm first flagged risks at Supermicro in 2022. So, Chris, this is fascinating because this is sort of the intersection of a fascinating story in the stock market and the hottest story in the stock market, AI. So tell me how that works in terms of what your platform does, what your large language model does.
Yeah, so as a financial AI platform at Hudson Labs, one of many things we do is look at the concentration of related party risk across all U.S. issuers. If you think about related party transactions and other types of forensic risks, it's an incredible application for AI because it's unstructured data. It takes a lot of time to dig through all of that, but also there's a lot of noise, and that's one of our biggest contributions to the space is getting rid of boilerplate, finding the signal versus the noise. But because of that, we have a related party concentration risk screen, where Supermicro was one of the highest risk companies and simultaneously was ranked quite high on our other forensic risks. Yeah.
So this screen is a result of going through hundreds of thousands of SEC filings, because that is time consuming. Nobody wants to go through one SEC filing, let alone 800,000 a year.
Exactly. And in a situation like related party risk, a lot of related party disclosure is meaningless, boring, and not material. So if you're trying to do that using a keyword search, it's going to get you mostly information that's irrelevant, which is why you need a more specialized model that understands content, context, et cetera.
So this screen, which flagged Supermicro, the related party risk, it flagged the ties that Supermicro had with AbleCom as well as CompuWare. And AbleCom, I mean, there are a lot of people out there who are deep into the Supermicro story, but AbleCom CEO is the brother of the founder and CEO of Supermicro. So there's a lot of strange ties there as well.
Yeah. So Supermicro was flagged on multiple screens. The most interesting one was, of course, the related party concentration risk, because it was one of the highest risk companies for that risk category. And you're right, it was a very unusual web of family relationships with both AbleCom, CompuWare, and also interesting, the terms of those relationships were very clearly not commercially normal, at least from where I'm sitting. One example is they were selling into CompuWare at below market prices. That's all available on the public record. And, I think one of many things that was abnormal about both the AbleCom and CompuWare relationships.
So thanks for coming on. It's really interesting what you do. I'm wondering, so related party, that seems like a fruitful place maybe to look. But what about things like channel stuffing and, inventory marking, things like that? Can you do it as well with those kind of, I guess, I don't know, those are the keywords or however you want to think about it?
Well, that's exactly what's so interesting about both the CompuWare and the AbleCom transactions is they're set up in such a way where when I look at it, it almost looks like it's inviting both round tripping and channel stuffing. CompuWare is both a manufacturer and distributor, so they're coming in two different ways. For both AbleCom and CompuWare, there's the option to ship on consignment versus sale. There's just a lot of discretion when you look at the details of those transactions, which would, to me, as an ex-CPA, raise questions about, is there an opportunity there's absolutely an opportunity for round tripping and channel stuffing. Whether or not it was in fact happening remains an open question. But the fact that they were doing it in the past and settled with the SEC for these types of issues does increase the risk.
I'm asking this question hoping you know the answer, because I'm not looking to tee you up, but you have a proprietary forensic risk score calculator.
Yeah.
Anything over 70 raises your antenna. If you to go back and look historically, how many times have you got a reading north of 70 and then equated with a stock sort of falling out of bed, being able to short the stock based on that score and being successful doing it, if that makes sense?
Yeah, we have some great backtesting on our website, but it's very highly used by people who are actively looking for short ideas, which speaks to its accuracy. Also highly correlated not just with price collapse, but also things like class action litigation. But really, what we're testing against is, does this relate in SEC enforcement action in the next 3 years, and that's how we evaluate efficacy.
Any companies you're going to unveil in terms of landing that north of 70 score?
If you'd like to know more about which companies are high risk, I suggest becoming a Hudson Labs subscriber. But I do want to just give a teaser that there's at least one other company on my radar with similar related party risk profile to what we've seen at Supermicro in the biotech space.
Somebody else is going to be a next Supermicro in the biotech space. Oh, yes. You better get that subscription going real soon for that AI product, right? Subscribe. This is the new future, friends. AI subscriptions, right? That's how it is. You're subscribing to proprietary technology, algorithms, all this stuff. Anyway, That's the future. All right, we got 3 hours already. I think you guys got the picture. You guys got the picture. Let me play this video for Bitcoin. People are really interested in Bitcoin, right?
We've talked this trading range out of our mind, and I think that we were so correct on each turn that it took. Even right here, we said we are going to have some kind of reaction. Why? Because there is still some supplies coming in at the around all-time high, and we're going to have some reaction. And obviously, the election and the win by Trump is the catalyst for the today's bar. So with that, there is only one question that we have at this point. Are we done with the trading range? Is this a good breakout? Or should we be expecting a little bit more of the consolidation? What is your view of this?
So we have the downtrend, ends climactic, we have the test. We have a very good rally here. This is our reaction from the overbought condition here. And we hold sideways, as we know. I took this spring, then we come on up, and then we break on out through this downtrend channel. We come a bit muted over here into this resistance level. Okay, we can see the texture of buying as opposed to this diminishes. Let's have a reaction, and look at the reaction. Very favorable reaction. It dips down into the breakout bar. That's bullish behavior. And then we break on up over into, like you've drawn here, into these highs. Okay, let's see what kind of selling comes out. So we come back down. This is our selling. And again, we don't test this support level. We actually technically spring kind of these highs over here, Roman. Again, so low, higher low, higher low with a spring, higher low, and now we're attempting to break through, and we're actually breaking out above here, Roman. So this whole action here, to me, is a change of behavior, and we are still in the change of behavior wave here, Roman. There's nothing untoward. I like the fact that this one bar manages to just accomplish and break through all of this and go into the all-time high. And our angle of ascent, as you've just drawn, is changing here, Roman. So we might have a little bit of testing. And then because we can see that over here, we break on out to this resistance, we have a little reaction. But I don't think we'll test back down to the lows here, Roman. But I do believe we're in the midst of a cob, and I think the stage is set for high prices here, Roman.
Yeah, what's smacking? Everything's going to be smacking pretty soon in 1 month. So come back. We'll see. I'm going to have to be more organized into December. We're going to have to get everything set up where I just list out tickers. Boom, 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 boom. I just put out like, okay, this is how I would trade it. Stop here, long here, price targets, this, that, probabilities, everything. I don't know. We're going to have to figure that out into December. From now into December, that's my goal. So I'm going to slowly start drip feeding where I'm going to present just the tickers. And, you know, everything's just going to be like a short. Everything's going to be like within 1 hour or less, right? And then even then, I could bang it out real quick where it could be consumed in 1 minute. Boom, 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 boom. You guys should understand exactly how I approach things in the market. Very simple. I just draw horizontal lines. I put support, resistance. I just look at the moving average, everything. And this weekend, I'll probably go over through some tape reading lessons and things like that. I get paper, get like you. Like $200. 200, man, you gotta get a job. Yeah, you gotta save up, man, somehow. Like it's hard to get a lot of capital when you have little capital. Like you first gotta build it up somehow. And you know, I mean, I know a lot of people might be like, oh yeah, you gotta be options gambler or something like that. And yeah, I mean, I don't know. It's tough. It's tough. You got to have that initial capital. I would say, like, hopefully you guys can make it to 100K within several years, after working, but that's not really practical for most people. And yeah, it's tough because I don't know if you can wait 10 years. I mean, that's the only reason I'm doing this, is because I don't believe like you could do things like the way I did it, where you could just invest in something long term for 10, 20 years, turn 5 G's into 100 G's. Like, by then you'll probably be like, shit, inflation's so high, blah, blah, blah. I don't know. I can't really say. So it's tough. Having capital is so important because capital makes more capital, right? That's just how it is. That's just how the system works. You gotta get more capital, figure it out. So baseline, it's all about getting that job, try to get a better job, get promoted. I mean, that's how I did it. But, I had a head start. I learned about investing way earlier, so putting a few $1,000s in the right stocks over 10, 20 years, by the time you graduate and go to get your first job and this and that, you're already at a good position. That's really the tough things. And a lot of that comes from parents. And my parents did not believe in the markets. It was only because of my pressuring them that they did it. And I think Gary has a similar story. A lot of people, Rashu, yeah, their parents are risk averse. Not taking risks is detrimental a lot of times. Man, you're stuck in the same status, class, position when you don't take risks. Really bad, really bad. So you don't want to be overly risky, reckless, but then you don't want to be afraid and scared all the time too. They'll keep you in that class, right? That's the same type of personality that keeps you in that office job all the time. You're always afraid. You're always looking over your back, huh? I never did. When I was working, I never gave a 2 F's about anything. Anybody could fire me at any point. I didn't care. And they knew it too. That's why I could mouth off and like skip meetings and yeah, it was fun. It's fun. Yeah, it's fun when you have an office job where they knew they couldn't touch you. Like, you could just do whatever the heck you wanted. So you got to play the things right. The cards, the cards that are handed to people are not going to be the same. You're going to have to analyze your odds and things like that. It really is a big poker game, isn't it? You're just looking at your cards. You're going like, shit, what am I going to do with this? I don't know. All I could do is just give you some tips here and there. But but like I said, like, you could see right from all the streams I've been doing, it's not hard. I don't take the risks myself, right? Like, I could show you that AOI stock or HIMS or that. I never took those. I didn't took those risks. But with simple chart reading, you have a chance at least. Like, let's look at HIMS. Like, yeah, just based on this, it was like, if you just bought here, $13, that would have been good right back in September, I guess. And then if you go to the daily chart, you could have did it again at 18. That was your second chance. You missed that. Well, okay, fine. And I'm just looking at charts. So look at that. I do the weekly chart. You see it drop to the 40. It hits its support here. That would have been a good time to buy. There's no guarantee. Like, it could have crashed, right? But that would have been a good time to buy. Okay, fine. It goes up. Let's say you missed that. Then you go down to the daily. You saw this pattern repeat again. You saw it. You saw it again. It goes back. It goes back to the 40 daily. So up here was the 40 weekly at 13. Then you go down to the daily, the 40 daily, and it's 18 and a half. You could have bought there, got a quick trip up here at 24, sold it or whatever. You could have kept it too. It doesn't matter, because on the long-term picture, it could have. But like I said, everything is fractal. That's what I mean by fractal. I think both Northern and Southern California are looking all right today. We actually have unusual hot weather in the fall compared to the previous year. I think it's the La Nina bullshit. La Nina. Like, I don't know what's going on with the La Nina right now. So I don't know if we're gonna get a ton of rain in January, but it could be like, oh yeah, we're pretty hot, nice and warm still for for the fall. So then we might have to worry about the La Nina later on. Anyway, so you can see that example, and then AOI, yeah. I mean, like I said, this company is trash, but based on what I'm seeing, like let's do something quick here. I could do a quick support here because this was a big bar, bounced off of that again, so I know it returned here, so I probably would have gotten a piece if I wanted to gamble. There's no guarantee it wouldn't have just broken down and completely collapsed. But let's say I wanted to take that chance. Yeah, I would have put some chips on the table. But the real reason is look at the monthly. Look at the monthly chart. You got the 40-month chart, right? The 40-month average turning up, hitting exactly at the same spot as here. And you have the 18-month going up. So even though it looked terrible, look at the daily. It just looks horrible. Down, 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 down. There's many reasons to say like it's worth a shot to go long at $6.75 or whatever, right? There was no guarantees, but the odds are better here. So this is just gambling, folks. We're just gambling here, but if we're going to gamble, at least we're being smart about it. I can actually pull this line back. Like, let's say I took this and pulled it all the way up here. There's a lot of significance of this line, right? So yeah, when you see a lot of things come together like that, it means something. So just follow the charts. Follow the charts. You want to gamble, at least gamble smart. And the only way is through chart reading. If you can read this chart, you would have been like $7 up to $30. I mean, me personally, I wouldn't take the chance. I don't need to, but I know a lot of you folks, you want real quick gains. And if you want to do that, you have to get good at reading this stuff. Now we're on the move already. Now, does it mean we're going to get back up here to the hundreds? I don't know. I told you this company is so trash. It has one customer. So to be continued. All right, guys. Oh, it's over 3 hours already, 22 minutes. I think the next live stream will start for our next 24-hour live stream. Let's see if it started already. Okay, somebody's already started a stream. So I'm going to give you the link. You can go over there. Put in the chat. All right. So remember to like and subscribe. Donate to Portia. You see the Cash App at the bottom. All right. Here's the live stream that's going on right now. Go over there. If you like it, give the money to Portia. You can give it to anyone else, Stanley, whatever. Don't give me Cash Apps, please. I don't need the money. All right. Don't need that. As you can see, I don't need that. Give it to Portia. And then if you don't, you give it to Stanley or HB, give it to John. the whole crew could get the Cash Apps. Don't give it to me. I'm just here to stir the pot, all right, and give you financial advice. All right. 3 hours, 30 minutes. So this weekend, I'll try to come up with something, make some PowerPoints, do something like that. And we'll go over some old videos where I can show you some of the Wyckoff chart reading stuff. and you can study those. Those are good studies. Very good. All right. See you guys.